for Apple this year, maybe like a further 10 million unit cut or 5% for 5% of volumes. So there is a bit of downside, and it's a headwind on stocks.
Here's the latest. Questions mounting for Apple's progress on AI. iPhone sales plunging in China and renewed pressure from regulators in Europe and Washington. Dan Ives of Wedbush remaining bullish right in this. We've been through many challenging periods in the Apple story, and we handheld investors through these stormy periods just like today. Brighter days will be ahead for Apple. They've got an outperform rating and 250 price target. Dan Ives is with us right now. Dan, thanks for being with us, sir. I know you're down under in Australia. You've just got back to there from a trip around Asia. Can you tell us, Dan, what you learned from there and just how big is the iPhone slowdown story in China?
Yeah, look, I mean, we're seeing clearly negative sentiment, not just on the street, but it's validated by the price cuts that we're seeing for iPhone. Look, I think it's a white knuckle period, no doubt, that Apple's going through. But my view is that after, call it 1 to 2 quarters, they get onto the other side of this with a pent-up upgrade cycle. And I believe it's all right now about AI. You do not want to be selling this stock into AI coming to Cupertino. That's why this is, in my opinion, not the time to throw in the white towel.
That's Apple, but it's not just Apple. It's Tesla too, and there's a slowdown in China as well. Dan, you've had a buy on the whole way down. The stock has been cut in half, cut by a third, something like that, year to date. I think we're down something like 29% so far in 2024. Dan, why is the thesis still the same for Tesla?
I mean, because I view it as that they're cutting prices. They're going to squeeze competition. And I think when you look over the next 6, 9, 12 months, they're going to go into the next phase of growth. I think margins trough out. Right now, I mean, I'd say sentiment is as awful as I've seen in 3 to 4 years. And on the other side, you have massive earnings power that's ultimately going to be driven by more and more volume, plus the AI story that comes to Tesla. And I think, look, my whole point is we've been through this many times in Apple, many times in Tesla, and clearly the bears are piling on for good reason. But this is not the time, in my opinion. I think it's just the middle part of the next growth phase in both stories.
So when you talk about the AI story coming to both, and I want to start with Apple, there's a real question of whether they'll be late to the party, right? I mean, this idea that they're going to push right now into artificial intelligence just a couple of months before Samsung is set to release their artificial intelligence infused phone. Are they too late? Are they still really immune to true competition?
Look, I don't think they're too late because there's 2.2 billion reasons they're not too late. I mean, that's the install base in terms of iOS install base. And when you look at what Cupertino's been able to do again and again, it's monetizing that install base. And the services business continues to be rock solid. You combine this with now AI, not just coming to what I believe is the App Store, but AI functionality coming to iPhone 16. That 1-2 punch, I think that we look back at this was more of a golden buying opportunity than ultimately the time that Apple becomes a structural negative.
I think there are a lot of people who probably would be more sympathetic to that view than the one with Tesla, especially in light of Apple's own move to get out of their vehicle manufacturing effort. This is not necessarily the sort of container for all AI and for all of our hopes and dreams, the traveling living room and bedroom and office that a lot of people had expected. Why do you think that Tesla can win on artificial intelligence when a lot of people are saying maybe it's just a car company and the car business is hard?
And they've said that for a decade. And I think it comes down to when you look at Rivian and others, just how hard it is and what Tesla has been able to accomplish. I think this is a growth story that we are still in probably the second inning of where this is broadly going. They have $30 billion in cash. They're going to squeeze competition. And when you look over the next 1-2 years, you're going to have 3, potentially 4 new models. And look, has EV demand softened globally? Of course. But this is just them going through a challenging period onto the next phase. We will yet again be on what I believe a growth frontier for Tesla, even though clearly right now it's not roses and champagne, and we're navigating a very, very nerve-wracking period for investors.
I want to understand, Dan, where that growth is coming from, at least in the near term. Stateside, you're seeing the problems to such an extent that GM are considering hybrids because the demand for an EV pure play right now just isn't there the way they thought it would be. I'm thinking of a clear and obvious risk factor in China right now, Dan. As you know, the White House is looking at national security issues around Chinese EVs. Now, Dan, it's not unthinkable to imagine a world where the United States makes it almost impossible for Chinese brands to sell their vehicles into the US market. Dan, what do you think is going to happen to foreign automakers trying to sell into China if that's the way of travel for the US administration?
Look, it's a tightrope, no doubt. I mean, the Beltway, what they're doing, you know, potentially on the China national security issue, it's a worry because they're retaliatory. And that's added right now, I think, to this black cloud over Tesla in terms of where that could go. But I do ultimately believe bark will be worse than the bite. And it comes down to Tesla is a trophy case within China as well. I mean, just given, you know, how they built Giga out there in Shanghai. So in my opinion, this is a piling on. There's clearly a lot of negative news, but I believe we get onto the other side is when we look back and it was just a bad turbulence phase and the plane wasn't going into the ocean.
Dan, I've been racking my brain for a time when you were bearish on any of these names, and one of them was when Elon Musk bought Twitter, now X, and you worried about reputational risk. There has been still a lot being talked about with respect to Elon Musk. How much can you strip out Tesla and the hope story and the dreams from the volatility of Elon Musk?
Look, I mean, Musk is Tesla, Tesla is Musk, the hearts and lungs, right? And the genius of Musk, clearly there's a downside, as we've seen with X and, you know, some of those sort of circus show that was an overhang in the story. But I think investors are able to bifurcate. I think it's understanding now what Tesla's doing, what they've accomplished. Look, is X an overhang in terms of, you know, worries about selling more stock and, you know, some of the issues they've had? No doubt, it's a spider web. But if you look going forward, Musk, I believe, yet again will navigate Tesla through these growth challenges, even though right now, I mean, I'd say the New York City cab drivers bearish on Tesla and Apple because of these issues.
Hey, Dan, wonderful to hear from you. Enjoy Sydney. Fantastic city. Dan Ives there of Wedbush. Not jealous at all. I want to go to this story from Mark Gurman and Drake Bennett. Here's the headline. What a headline. How Apple sank about $1 billion a year into a car it never built. Yeah, basically, at what point can they use some of this insight and research and just translate it directly into AI, or how far back did it set them to try to jump on this idea that your robo-taxi and your automated vehicle was going to transform the way that you thought of life, right? I mean, I think people are rethinking the entire narrative around these, maybe prematurely, sure, but that's the zeitgeist right now. Tesla in the pre-market down again, by the way. We're negative here by 1.4%. in early trading. Coming up for the second hour of Bloomberg Surveillance, Ed Yardeni of Yardeni Research, Tobin Marcus of Wolf Research, Herman Chan of Bloomberg Intelligence, and Christina Campmany of Invesco. From New York City, equity markets on the S&P 500 shaping up as follows. On day two, with Chairman Powell on Capitol Hill, your S&P 500 is positive by 0.2%. Yields are going nowhere. 4.0962% is where we are on the 10-year. A springle of economic data a little bit later. Jobless claims. The last big read on the labor market going into payrolls tomorrow. Payrolls Friday just around the corner from New York. This is Bloomberg.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Keeping the faith in billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3 million% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. A About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
This is a very different Fed cycle because it's a recalibration of policy.
This is a Fed just sort of right-sizing policy, given the fact that inflation has slowed.
What measures are they willing to tackle from a fiscal perspective without, again, upsetting this economy, which remains still strong?
Essentially, what we've discovered is that there's an underlying resilience that just can't be ignored.
I think they want to cut rates, but I don't think they're in a rush to do it, and I don't think the economy is going to give them the excuse to do it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Base is absolutely loaded. We've got a fantastic week of price action lined up for you, given what's on the schedule. Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance begins right now. We've got a State of the Union down in Washington, D.C. Anne-Marie is in the nation's capital. We'll catch up with AMH a little bit later. Then we've got a trio of central bankers to talk about. At the Federal Reserve, Chairman Powell on Capitol Hill for day two. President Lagarde of the ECB, a news conference, an ECB rate decision coming a little bit later. And Governor Ueda of the BOJ. That BOJ meeting this month might not be boring.
There is now a 70% chance that people are expecting them to hike rates to perhaps zero. It would be the first move of that nature going back to 2007. And it raises this question of whether that will turbocharge or whether it'll put a damper on the rally of Japanese equities. Basically, does this give people more conviction that this is a new investment thesis and it is no longer the forgotten decades?
Certainly giving them some confidence to buy the Japanese yen this morning. Dollar yen session lows negative 1%. We've broken through 150. We're at 147.82. Let's get back to Chairman Powell. It's day two. The data has been fantastic in 2024, yet the message remained the same, even though the data has changed. And I often say, if your message stays the same when the world around you changes, then the meaning has shifted as well. The meaning of those comments is slightly more dovish than maybe a month or so ago.
When I listened to those comments, the meaning to me was that this is not a Fed chair that's worried about financial conditions easing. This is not a Fed chair who's concerned about the fact that we are seeing strong growth in certain pockets. This is a Fed chair that wants to cut rates and is going to do so, and it's just looking for an opening to justify it.
Even with stocks close to all-time highs, credit spreads incredibly tight. Jobless claims, where are they? 215. Get jobless claims a little bit later this morning. 216 is the estimate. Put all the data together. The employment component of the ISM services read came in much softer. The ADP basically in line. I know you've got some thoughts on JOLTS, but a little softer there as well. All of this lines up just to say, okay, things are decent, but we're not getting those booming reports we got earlier in the year.
And we're getting that disinflation. It does seem like it's messy, but it's generally continuing down that trend. The data's been messy. It's been really tough to extrapolate.
It has been for a while, eh?
It has been for a while, and it feels like we're at some sort of tipping point, but we've been at a tipping point for about 7 months. So what does a Fed chair do with that? And what we've heard is basically they want to err on the side of preserving this economic cycle. And to me, that is massive and is part of what's been turbocharging this goal to kind of broaden out with respect to equity allocation.
Speaking of tipping points, NYCB in yesterday's trading, New York Community Bank, there was one point there where we're down close to 50% on the session, and you're really worried about the future of this institution. Then boom, things change fast.
Worried about the future of this institution, not worried about the banking sector at large. This story to me, and please, you can send me your hate mail, but to me, this has moved from potential macro risk to sort of a more personality intrigue of who's going to run this, exactly what the policies are going to be around it, in a very idiosyncratic moment of U.S. rent control or New York City rent control. This is not the same story that it was a year ago.
The stock right now is just about positive in the pre-market, just off session highs. New CEO, equity investment from the former Treasury Secretary, Steve Mnuchin. There's so many dimensions to this story. It's unbelievable.
Exactly. I mean, do you think that he's trying to angle for a policy shift? Do you think he's just trying to reprise his reputation?
Oh, I think if you do get a Trump administration, then maybe you probably are going to get a policy shift. But based on what we heard from Chairman Powell, he might be on board with that policy shift anyway.
Exactly. Why should you hold more capital if you can extend more loans? Again, there's a lot going on that suddenly gives this tailwind to banks more broadly in a way that a lot of people weren't expecting, even though typically if you cut rates or rates are lower, you would think that would be negative for banks that are actually extending loans. So watch the space, and JP Morgan will hit another record high.
It's why you've seen a series of all-time highs on the nation's largest bank. Equity futures right now on the S&P 500, positive by 0.2%. Here's the stage. It looks like this. Yields are unchanged on a 10-year, 4.1%. The euro going absolutely nowhere. That rate decision, 1 hour and about 10 minutes away, 108.95. Coming up this hour, Ed Yardeni of Yardeni Research, as stocks rebound on Chair Powell's testimony. Tobin Marcus of Wolf Research looking ahead to Biden's State of the Union. And Christina Campmany of Invesco looking for, quote, a few maintenance rate cuts later this year. We begin with our top story. Stocks rebounding after Chairman Powell reiterated rate cuts are likely at some point this year. Powell's position unchanged as a growing number of economists are forecasting no cuts in 2024. Ed Yardeni of Yardeni Research writing this: the stock market is having a significantly positive wealth effect on the economy. That's another reason to believe that the economy will remain resilient, and another reason the Fed might hesitate to lower the federal funds rate for a while, maybe a long while. Ed joins us now for more. So, Ed, I wonder what camp you're in now, and thanks for catching up with us, sir, as always.
Sure.
Apollo, no rate cut this year. Mizuho, just yesterday on this program, no rate cut this year. Where's Ed Yardeni and Yardeni Research on the same issue?
I'm basically in that camp. I think at most we'll get 2 rate cuts. 3 is possible, but at this point, I think those who are saying that rates may not come down have the weight of the evidence on their side. The economy is doing fine, as Chairman Powell said. Inflation's moderating. Why mess with success? Things are going just fine. And the notion that you have to bring the Fed funds rate down because inflation's come down and that real rates are going to slow the economy down, that's a debatable theoretical point.
Ed, you've made the point for a while now that you think this is going to be the roaring 20s. Does that thesis still hold? Why do you extrapolate this out, say, just beyond this year? Why do you think this has got a much longer runway?
Well, look, the economy is turning out to be remarkably resilient in the face of all the challenges, particularly the surge in interest rates. But I think what we really have seen is not just a tightening by the Fed, but also a normalization. Interest rates are back to normal, and the economy is proving that it can really handle it quite well. But the stock market really started to discount a roaring 2020 scenario on, I know the exact date. It was, we all know it. It was November 30th, 2022, when OpenAI introduced ChatGPT, and the excitement about AI has been extraordinary ever since then. So the stock market's already discounting that technological innovations, particularly AI, are going to increase productivity, and productivity is the fairy dust of the economy. It allows the economy to grow faster, inflation to come down, real wages to go up, and it's great for profitability.
Which is the reason why it was interesting yesterday that even though we got an overall index gain on the equity market in the U.S., you saw those big tech giants sell off just a touch. What does that tell you about where this rally is?
Well, I think I'm actually delighted to see that the market's becoming a little bit more discriminating in terms of the mega cap 8. I like to focus on the mega cap 8. Everybody else, I like movies, so I want to include Netflix in there. But if you want to just focus on the Magnificent Seven, so-called, they're starting to split off. Apple and Tesla are having some issues. NVIDIA still looks good. On the technology front, I think it's hard for me to see the technology stocks really getting hit hard here when on March 18th, NVIDIA is going to have a festival in San Jose, an AI festival. They're going to have a convention for a couple of days just extolling all these wonderful things that AI can do. And I think the market's going to get pretty excited about it.
I love this, Ed, that we're getting to the point of enthusiasm about AI, that they're going to hold a festival, and that will definitely fuel further gains. And you're probably not wrong. So that is where we are. I am wondering whether the thesis holds in that the rest of the 492 stocks in the S&P 500 can get that same tailwind of productivity and those other gains if the Fed doesn't cut rates, because these are the companies that arguably are more tied to them.
Yeah, and by the way, that is very relevant to the so-called real interest rate. And maybe the inflation-adjusted federal funds rate should be higher than just the past 10, 15, 20 years, because we're back in an environment where productivity is growing faster, and that means that the economy can, in fact, live with these level of interest rates. So, yeah, I think, looking ahead here, there's potential for the economy to grow faster than expected because of productivity.
As we look ahead, can we look back, Ed?
Let me, I didn't really finish.
I thought you had done. Forgive me. Carry on, Ed, please.
No, that's fine. I sounded like I finished, but I didn't. I just wanted to answer the question, is that, the stock market's been doing pretty well here. The notion that it's only been 7, 8 stocks that have leading the way is absolutely true, because they've been so spectacular. If you look at the other stocks, we have lots of industries that don't have any of these Magnificent Seven stocks, and they're up 20% or more. So the breadth of the market isn't that stocks haven't moved. There have been plenty that have moved. It's just they haven't moved as fast as the big ones.
Wanted to finish on this, Ed, if we can. It's a question you asked yourself. As we look back, if this is the 1990s, is it 94 or 99? Ed, what was the answer to your own question?
I think it's December 5th, 1996, when Alan Greenspan, I think I got the right date, when Alan Greenspan gave a speech, and he said, how do we know if we have irrational exuberance? And I think everybody's asking that question right now.
I think we are. Not just you, Ed. Ed Yardeni of Yardeni Research. Ed, thank you, sir. Irrational exuberance. As people often remind us, it wasn't right at the tippy top of the equity market boom.
Yeah, and when you don't think that it is irrationally exuberant is often when it is. I do love this idea that the wealth effect is going to keep this going, given the fact that people are getting their equity returns. And it goes to what Sharon Bell said, which is when you're feeling good and you're getting stock returns, you go to Gucci, you go to Hermes. I wonder at what point this starts broadening out. To
you say you go to, I mean, some people might go to Gucci. I'm not sure everyone does, but I take your point.
You have yours, everyone has theirs.
Jensen at NVIDIA has been more important to this equity market than Jay at the Federal Reserve has. It's got to be the takeaway of the last few months.
And the ramifications for that, and that's the reason, just to tie it full circle, the ramifications for that in the economy and the Federal Reserve in terms of inflation, it's telling that they don't think that it's a significant deal, that the financial conditions aspect isn't necessarily problematic in their achieving that 2% price target. That, to me, is really compelling and something I'm watching for.
Fed Chair Jay Powell has said explicitly strong growth isn't a problem, and basically hasn't really pushed back against what's happened in markets either. Equity markets close to all-time highs.
Which is the reason why, to me, the fact that person after person lining up and saying there might be no rate cuts this year is actually a sea change and raises a question of what is the new normal in terms of a neutral.
The list gets longer. So we've got Torsten Slok of Apollo, we've got Steve Rasciuto of Mizuho, and I think Ed Yardeni there was kind of on the same page as both of them.
Basically, if you're looking for reasons to cut rates, you're not finding them in the data. He basically made that very clear, and the data is showing that a lot of these equities can keep rallying even with rates at these levels.
Equities rallying this morning. We're positive by 0.2% on the S&P 500. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Houthi militants claim responsibility for an attack on a commercial ship off the coast of Yemen. 3 crew members were killed. The rest abandoned the ship, according to British and American authorities. It's the first confirmed death of crew members since the Houthi attack started in November. Minneapolis Fed President Neil Kashkari says he might lower his expectations for Fed cuts this year. Back in December, he said he had projected 2, but now he says his forecast will show 2 or potentially just 1 when officials submit their new projections in March. NYCB shares higher pre-market by just 0.3%, so barely, but the struggling real estate lender rallied a lot yesterday after receiving an equity investment of more than $1 billion from investors that include the former Treasury Secretary Steve Mnuchin. NYCB shares have lost almost a third, 2/3 of their value since the bank had slashed its dividend and set aside more provisions for expected loan losses. That's your Bloomberg Brief. John.
Danny, thank you. Up next, a pivotal State of the Union for President Biden.
We're better positioned than any country on earth right now, but we have more to do. But here at home, inflation is coming down.
That conversation up next with Anne-Marie down in Washington, D.C. This is Bloomberg.
source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Today, as the border, the economy, and the November elections dominate the headlines, President Biden will deliver his State of the Union address. Balance of Powers' Joe Matthew and Kaylee Lyons will bring you live global coverage starting at 8:30 p.m. Eastern. Bloomberg, context changes everything.
Busy morning today. Equities up by 0.2% on the S&P 500. ECB rate decision coming a little bit later on this morning. After that, you'll get jobless claims in America. After that, you'll hear from Chairman Powell for a second time on Capitol Hill. And then a little bit later, this. Under surveillance this morning, a pivotal State of the Union for President Biden.
We're better positioned than any country on earth right now, but we have more to do. But here at home, inflation is coming down. Here at home, gas prices are down $1.50 from their peak. Food inflation is coming down, not fast enough, but coming down. Inflation has fallen every month for the last 6 months, while take-home pay has gone up.
Why so angry about those things? Aren't they good things, Bramo? You'd think they would be.
It's energetic.
Are we getting angry Biden later?
Your anger is somebody else's energy, maybe.
Your pay's gone.
I know. We'll discuss it, I'm sure, tomorrow.
Here's the latest. Bidenomics is once again likely to be high on the agenda in the president's State of the Union address. The speech is a critical moment for Biden as he frames his pitch for the November election. The president planning to ramp up attacks on Donald Trump's economic agenda, circulating memos contrasting their agendas during this address. Anne-Marie is back with us down in Washington, D.C. AMH, just to pivot slightly, I thought we would be starved of debates. Based on what we heard from the former President Donald Trump in the last 24 hours, he's ready to debate President Biden anytime, any place, anywhere.
Well, that's what he says. Remember, the former president would not get on a Republican debate stage when it came to the primary, but now that Nikki Haley has said she is bowing out, he says he's ready to take on President Joe Biden in a debate. What's interesting, Jonathan, is that the Biden campaign basically said, well, you can see what the president has to say. Please tune in this evening to the State of the Union, but didn't say whether or not they would accept that debate challenge. And they said, let's see how this cycle persists. A lot of people are talking about, would we even see these two take a debate stage? Potentially we will. And the former president said he's ready for it.
What are people in D.C., where you are right now, saying about just how President Biden faces a much higher bar right now with this State of the Union and just in general, in terms of his delivery, in terms of his policy projections, in terms of, exactly every aspect of his performance?
Well, people are billing this as the most important speech he will give of his presidency, and potentially it could be his last State of the Union if he is ousted in November. And given the polls continuously show that Americans are very concerned about his age, our swing state poll shows 8 in 10 are concerned about his age. The bar is actually for him to just make sure there's no gaffes. He doesn't bumble. Remember, the pressure is on Biden, given that special counsel report that says he's a well-meaning elderly man with a poor memory. He needs to make sure this evening he pivots to a well-meaning elderly man with a strong memory and that he's robust. And for that conversation, we should bring in Tobin Marcus, head of policy and politics at Wolf Research, who's been looking into this. Tobin, is this the bar for this evening, to just make sure that he comes out, that he can be an influential president up for the job at 81?
Yeah, certainly the thing that has gotten the most scrutiny is the question of performance. The delivery in last year's State of the Union, Jonathan just characterized as angry, but, I think we will see something very energetic. I mean, last year's State of the Union, for what it's worth, I think did go pretty well from a performance perspective. He famously got into sort of mixing it up with House Republicans on the question of entitlement cuts in the sort of early stages of the debt ceiling debate at the time. If they can manage to engineer another sort of organic moment like that showcases some nimbleness and energy and sort of quickness on his feet, I think that would be ideal for them. But short of that, I think just a crisp delivery that shows some energy and, to your point, sort of free of any notable flubs. And then, of course, there's the policy content of the speech, where, I think that this very much is going to be teeing up a proactive contrast between Biden and Trump. I think the Trump folks, the Republican Party more generally, is shifting into a kind of are you better off than you were 4 years ago mode. I think that the Biden campaign needs to and is going to reject that frame and instead try and make this a contrast of proactive priorities and values, sort of who's fighting for whom, and positioning Biden and the Democratic Party as fighting for the middle class and going after the rich, hence the rollout of kind of progressive policies that we've seen in the past 24, 48 hours.
You write in your note that you, unlike a lot of cynics, don't think talk is cheap, that a lot of this can translate to policy. The issue that comes up for policy with Biden and Trump is the extension of the Trump-era tax cuts. Regardless of who wins, we will see some extension at some level, correct?
Yeah, absolutely. So, we have about $3.5 trillion worth of tax cuts that are expiring at the end of 2025. The 2017 Trump's tax package made its corporate and capital gains tax cuts permanent, whereas the individual and pass-through tax cuts were largely temporary, expiring at the end of next year. In any kind of a divided government scenario, I think probably what we're going to see is extension of the tax cuts below $400,000. That's what Biden's proposing. They're going to reiterate their no new taxes under 400 pledge in the State of the Union tonight, and it's something they do take pretty seriously. That's about $2 trillion of the $3.5 trillion footprint. And then in the Republican case, I think they will be trying, like in a Republican trifecta, if we have Trump and a Republican House and Senate, I think they'll be trying to extend all of those tax cuts wholesale. And the question then is, what gets cut in order to help pay for those, or what other revenue sources get brought in. And I think that's, there are a lot of questions on that front that will determine, sort of much of how next year goes from a market perspective.
We're also expected to hear Biden talk about raising the corporate tax rate, about raising the rate when you buy back your own shares if you're a company. But I take issue with the fact that the Democrats had control at one point early on in the Biden administration of full control of Washington. Why couldn't they make these moves then?
Well, the two-word answer is Joe Manchin. The original version of their big fiscal package in 2021, what was then called the Build Back Better Act, the sort of early version of their reconciliation bill, did include a lot of those corporate raisers and raised multiple $1 trillion worth of revenue with, a grab bag of Democratic priorities going after both high-income individuals and corporations from a tax perspective. That package, of course, got stripped way down in terms of its content. The social spending was largely stripped out. The climate spending was kept in. And so there was less need to pay for them. And they ended up with this sort of rump set of Democratic revenue proposals that Manchin and Sinema were happy to get on board with. So, for example, they included a 1% tax on buybacks. Biden's now proposing to take that up to 4%. So, there's lots of ideas that, Biden's happy to go for, but that Manchin was not. But holding even 50 Democrats together in the Senate, I think, was somewhat of a surprising achievement. In retrospect, it's not terribly surprising to me they didn't manage to get their entire laundry list of tax increases done.
When the president's budget will be coming out, our colleagues are reporting, John Schwingrove, that Biden's budget got a touch more optimistic after NEC Director Lael Brainerd is pushed for and won a slightly lower interest rate when it comes to the 10-year. Do you think this will resonate with the American people, or they just say you're playing politics with your budget?
I don't think that is something most voters are going to notice. It is certainly tried and true game to kind of manipulate baselines to try and make those budgets look better. Of course, in the Trump administration, there are all these debates over kind of long-term growth forecasts and the extent to which, budget projections relied on unrealistic expectations about growth. For Brainerd's
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. Almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Right now on the S&P, positive by a third of 1%. Up next on the program, New York Community Bank receiving more than $1 billion from former Treasury Secretary Steve Mnuchin's firm. That conversation up next.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world.
From the UK, and I'm the inventor of the gel razor. And today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I developed the all-in-one. The idea is you pressurise the handle, the gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
A bit later, a decision from them at about 44 minutes time. The euro is totally unchanged going into that decision. 108.99, some forecasts from President Lagarde as well, and a suggestion from Simon French and Panmure Gordon that when you get that inflation forecast for the near term, it might be revised lower, which opens the door for him at least for this ECB to go before this Federal Reserve.
You know, I'm laughing because the ECB is the most non-event of today, and it might not be, right? But people don't even want to talk about it. You know, they're sort of saying, do we have to parse through this? There's going to be disagreements. They're not sure. I mean, to me, it's sort of fascinating how this has become such a less relevant story than the Federal Reserve and what happens there. It seems like people have less optimism about the ECB and less of a debate there.
Would you like to talk about the BOJ? We can do the BOJ.
I think the BOJ is really interesting.
Dollar yen right now, breaker 150, price action for Bramo, 147.88. We're negative on that currency pair by 1%. That is some real yen strength. In fact, the strongest day for the Japanese yen so far this year, off the back of a couple of stories here at Bloomberg. And if you are just joining us, I'll go through two of them for you. So one story from BOJ officials, according to that story suggesting that maybe those officials are gaining confidence in the wage data that's coming through, better than expected. The second story coming from government officials suggesting they're okay with the idea of a near-term rate hike. So everything's just coming together for Japanese authorities to hike rates.
Which is a reason why the market's pricing in almost an 80% chance of a rate rate cut, rate hike. I mean, they're going rate hikes. Everybody else is going rate cuts in the March 18th to 19th meeting. Key question for me is, what does this indicate? Is this beginning of something more significant, or is this just basically kicking it up to 0.25% to basically herald in this new era of more growth, a little bit more inflation, and frankly, a much better investment thesis for a lot of different investors?
Do you remember I called it Operation Ostrich? When all the other central bankers were sort of scrambling around, inflation surging, they want to hike interest rates. It was head in the sand in Tokyo. Head pops out. It's like, we need to raise interest rates maybe this month.
Although Operation Ostrich worked.
I know.
I mean, that's the thing, is that, you know, people, and myself included, I can have as much snark as I want.
Sure.
But the bottom line is, it's been working. And something is going very right for that economy. And a lot of people are betting with their money.
Oh, it was a gift. It was an absolute gift. A multi-decade effort to get inflation expectations higher, and then we had this global inflation story take off, which they were just like, bring it on, and everyone else was like, no thank you.
Yeah, but they've done it in a way that's given people real optimism. And to me, I wonder how much this is the China story too, people shifting away from China and looking elsewhere. Either way, I am really interested in this meeting.
Dollar yen, 147.84. Bramo's on board. Under Savannah's this morning, President Biden delivering his State of the Union address at 9 p.m. Eastern tonight. Biden looking to convince voters he's prepared for a second term by touting his economic agenda and attacking former President Donald Trump's. He's also looking to reassure voters who have concerns about his age and mental acuity. And it's the last point I know which frustrates you, Lisa, because a lot of the reviews of this State of the Union is going to be about how energetic he is later on this evening.
And frankly, I'm not interested. Like, on one hand, sure. But on the other hand, I want to hear policy, because it's the people around him that also are going to push it through. And the question is, what can he do, given the fact that there are certain caps in how much he can spend? Where does he shift around spending? We heard about some of the defense spending that he's going to be doing. How much does he talk about that versus lack of substance if we go back into character assassination on all sides? To me, again, it's sort of from a market perspective, I want to understand the meaning.
Yeah.
For trade policy, what do we want with our allies? What do we want with our adversaries? I want to understand about tax policy, and I want to understand about the deficit, and those things putting together. We're probably going to hear none of that, so, you know, we'll be talking about, you know, different things.
If you want a policy conversation, look to day 2 of Chairman Powell today. How's that?
Then very good.
On Capitol Hill, after reiterating the Fed expects to cut rates at, quote, some point this year, and answering questions from the House Financial Services Committee, Powell will face the Senate Banking Committee at 10 a.m. Eastern Time. The Fed chair has also faced pressure from members of that committee, including Senators Sherrod Brown and Elizabeth Warren, urging him to cut rates sooner. So there's Senator Warren, sent him a letter at the start of this year saying cut rates, cut them now. I imagine she's also got thoughts on his comments from yesterday on financial regulation, which was really the headline from yesterday's testimony.
It was the news, right? The fact that they're considering overhauling a proposal to have big banks increase their capital withholding by 19%. You know, do you enjoy these hearings?
No.
Okay, do we learn really anything substantive?
Very little.
So the fact that we actually broke news yesterday is interesting, the manner we could parse through that. The grandstanding, et cetera, it really raises this question, what are we hoping to accomplish here? I mean, not to be too, you know, dismissive, but what are we hoping to accomplish here? This is kabuki theater. I keep going back to this. Everyone wants to get up and say their thing.
What are we going to accomplish? A 2-minute campaign video from the senator from Massachusetts on bank regulation. That's coming up a little bit later. Let's finish on banks. New York Community Bank getting a lifeline. The struggling lender receiving over $1 billion of equity from investors, led by former Treasury Secretary Steven Mnuchin and his firm Liberty Strategic Capital. The bank also naming former comptroller of the currency Joseph Otting as its new CEO. Otting replaces Alessandro Di Nello, who was named CEO just a week ago.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
It came through pretty quickly, and I'm sure there were last-minute negotiations on pricing once the stock was halted and the stock was in a free fall. So it's great that the bank was able to get a lifeline and inject capital and potentially improve the reserve.
Yeah, the IndyMac question is really an interesting one, and we've been talking about it all morning. What does Steve Mnuchin want with this bank? Right. Considering that there were some accusations of predatory lending or certain difficult policies with respect to their mortgages at IndyMac. With this transaction, where is the value creation going to come from?
Yeah, it's going to be a turnaround story. So they have a blank slate to really change the narrative, grow the portfolio, improve the credit quality. But the thing that really comes back to is this is a very big organization, and IndyMac was much smaller when they sold the institution to CIT. And as such a large organization, is there going to be a willing buyer later down the road when they fix it up?
So they've got exposure to loans on buildings where effectively you can't put the rents up.
Right.
How do they change that?
Yeah.
Because that sounds like a policy issue.
That is going to be the big narrative going forward. Maybe it's a coin flip on the potential Trump presidency next year. And maybe there's some sort of, as a cynical view.
Let's get into it. No, let's get into it. Because Lisa raised the question. You think there is the potential here that this is a bet on a shift in policy? And do they have the authority at the federal level to make that shift?
I think that's something that probably is in their mindset going forward. Remember, the OCC is the agency that is regulating them, and if there is a change in presidency, there could be a change in regulatory posture and could introduce some more lax regulation going forward.
Just to frame this, where and how much value is there in this bank without some shift in regulation?
Right. Well, the market's telling you that right now it's trading at, based on the updated tangible book value, it's about half of tangible book value, which is about versus 1.1 times, 1.2 times the group. So it's still in a very distressed situation, but it does offer a lifeline for improvement going forward.
I'm glad John brought up whether this is a local or whether this is a federal issue, especially at a time where it's not just New York Community Bank that's dealing with it. We heard from M&T Bank yesterday, for example, with some of their rent-controlled related loans. How big of an issue do you think this is, not only from a monetary standpoint, but also from a property ownership standpoint, both in the banking industry and outside?
Yeah, well, the issues are really specific to New York Community, where they are the biggest player by asset concentration in the rent-regulated multifamily space. So it's less of a dire situation for a lot of the other banking institutions. And we're talking about like 20% of their portfolio is rent-regulated for New York Community currently. So any potential dings in their credit quality that will really affect them, whereas the other regional banks are much more diversified.
I believe it's anniversary week for the failure of SVB, which is not really an anniversary anyone wants to celebrate. But Lisa's mentioned this a few times. In fact, we both have. The fact that JP Morgan's trading at record highs, the fact that the rest of the regional banking industry, just in terms of the stock price, isn't being pulled down by what's happening by the likes of NYCB. How much progress have we actually made in the last 12 months?
Yeah, I think you can see by the stock reaction over the past few days across the group where it has been very much an NYCB-specific issue. And we've heard a lot of encouraging comments from the bank management teams over the current conference cycle this quarter, where everybody still feels very sanguine about credit quality, and we're muddling through all the issues.
Hammond Chand of Bloomberg Intelligence, thank you, sir. NYCB in the pre-market looks a little something like this. We're just negative by 3.5%. Keep an eye on that. Lisa, last year was about rate issues and mismanaging your rate exposure. It's the credit risk story that Herman's talking about. Can we really go through this cycle without credit issues? Can we really go through this cycle without any?
That's what I want to ask Howard Marks. Basically, if you talk about the exuberance that low rates created for so long, well, where are the zombies getting blown out at this point? Where do we see some of the sort of naked people when the tide rolls out that are exposed, right? Because this was what everyone was warning about, and why are we not there? And so this is really the key question, and right now people are shrugging it off. This maybe is one of the naked people in terms of rent policy, although maybe Steve Mnuchin has an inside ear on how to change that.
Possibly, possibly. Howard Marks of Oaktree joining us in about 20 minutes' time. Do not miss that conversation. He's going to be with us for about 30 minutes. He'll react to some of the ECB decision as well, so looking forward to that. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Donald Trump wants to debate Joe Biden. The former president posted on Truth Social, quote, "I'm calling for debates anytime, anywhere, any place." Trump had skipped the debates during the Republican primary. A Biden campaign spokesman says that if Trump is desperate to see the president in prime time, he can watch tonight's State of the Union. A March rate hike may be in the cards for the Bank of Japan. Bets for the month are gaining traction. There was stronger wage data and BOJ official comments to that effect. The yen is strengthening, blowing past 148 per dollar. More insiders are unloading NVIDIA stock. Two directors recently sold $180 million worth of share. NVIDIA closed at another record yesterday with a $2.2 trillion market cap. It trails only Apple and Microsoft in the S&P 500. And that's your Bloomberg Brief. John.
Danny, thank you. Up next, Chair Powell, sticking to script.
We believe that our policy rate is likely at its peak for this tightening cycle. We want to see a little bit more data so that we can become confident and so that we can take that step of beginning to reduce policy rates.
That conversation coming up next, live from New York City this morning. Good morning.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside of that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Big 60 Minutes coming up. Bit of data in the next hour. Jobless claims, central bank decision as well. ECB. You'll hear from President Lagarde in just a moment. Euro-dollar 108.99. President Lagarde about 60 minutes away. In the bond market, yields a little bit lower. The emphasis on a little bit, 4.1% on a 10-year. And in the equity market, we're positive here by 0.25% on the S&P 500. Under surveillance this morning, Chair Powell sticking to script.
We believe that our policy rate is likely at its peak for this tightening cycle. We want to see a little bit more data so that we can become confident and so that we can take that step of beginning to reduce policy rates. When we reach that confidence, the expectation is we will do so sometime this year. We can then begin dialing back the restriction on our policy. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year.
Here's the latest. Chairman Powell facing the Senate Banking Committee on Capitol Hill, 10 a.m. Eastern Time, after reiterating the Fed's stance on rate cuts in front of the House yesterday. Christina Campmany of Invesco writing this: "We can only look for a few maintenance cuts by the Fed this year and next year. The outlook for monetary policy and the economy broadly will be significantly affected by the election." Christina Campmany, I'm pleased to say, joins us now. Christina, good to see you. Before we get to the politics, it sounds like you're kind of on the same page as the likes of Apollo and Mizuho, who were calling for no cuts this year. Why do you think maybe it's just 1 or 2 in 24?
Look, I think that the Fed is still, we know that DM central bank policy's next step is easier. And I think Powell said it yesterday, we want to do that. They just seem to have this confidence issue. And it's not that we need better data, just we need more of it to have more confidence. So we still are in the camp that they ease 2 to 3 times this year. And I think beyond that, so much will depend on what the election outcome is and where we are kind of growth-wise.
What's our maintenance cuts? What's the difference?
I think it's what we were talking about when we got the signaling, what we thought was a clear signaling message from Powell in December around we've reached restrictive rates. As inflation comes down, we are able to make maintenance cuts to get off restrictive. We don't need to get to neutral. We don't need to go through neutral at this point, but we don't need to be as restrictive as we once were.
I'm so glad you asked that. I was thinking to myself, is it like a trim rather than going in and actually getting some sort of style shift? I'm curious, Christina, we were talking about this earlier, and we're going to talk about this with Howard Marks coming up. What does this mean in terms of where real rates should be, given the fact that we haven't seen more distress? Does it really mean that all these companies with over-leveraged balance sheets that we all said that were zombies are just fine now?
Well, I think if you look in the last year and a half, since the fall of 22, the street has had these rolling forecasts for a recession. I know that's something that we've talked about a lot of times, and it doesn't materialize, and we continue to have stronger U.S. growth, and this U.S. exceptionalism story keeps coming back, and we can't, again, across the street, these economists and policymakers are all having trouble contextualizing why is the U.S. economy so strong. So I think that it comes back to that. So we don't have a broad recession. It's hard to see signs of that. You have pockets of weakness and pockets of concern. Markets are concerned about private credit. Markets are concerned about the regional banks. But none of these are systemic issues at this point.
Well, this is the reason why, and John's brought this up, and I think it's a really important point. The leverage right now, where is it, right? The leverage is in the U.S. government. That people are talking about fiscal stimulus still being pumped into the economy. Is there going to be a price to pay for this? And I know I may be getting over my skis saying, is there going to be a Liz Truss moment? But is there going to be a Liz Truss moment?
I mean, again, when we look at rate markets and government debt, especially in the U.S., we come to that conclusion. It's really hard to see value in 10-year and longer Treasury bonds because we're not pricing in. The market has continued to give incredible trust to the Fed and its control of inflation and in faith of the U.S. government, right? Like, we are at 4% when you have recessionary fiscal type spending, and the only certainty that we have with whoever wins the White House is that you probably have more fiscal. So should it be more of a concern? Should we have a steeper curve and higher long end rates? We absolutely think so.
Your words, the economy and the outlook for the economy will be significantly affected by the election. Why significantly? What is it about this election that's so significant to you and the economic and monetary policy outlook?
I think, again, you may have more of the same from Biden, but we're at extremes in terms of fiscal and the spending and immigration. Again, going back to this growth in the context of U.S. growth and why it's been so strong, the immigration numbers have been a large driver. Now, is it a catch-up from COVID years if you didn't have immigration? Is it a broader trend? Is it something that sticks? I think we're at this precipice of what has driven the resilience of U.S. growth? And again, from a policy, are we going to close our doors even more? Does that drive then regionalization and a preference for LATAM? You know, like all of these trade tensions. I think there's a lot of things that will drive the economy and how we think about the world.
These are all thought exercises right now. Are they driving active decisions currently for you and the team?
Again, I think it's hard to sit here and say, what is the Fed going to do? What are policymakers going to do in 25? Because so much will depend on this. Is it thinking about how we invest in markets? It is, and I think it also forces you to think, what are some of the tail trades or positioning that you need to consider in the risk scenarios? And it feels like the risk scenarios it's extreme. It's not we stay the course or...
Which raises this question about what you said about longer-term treasuries and that you don't like them because of exactly this. So where do you go for that ballast at a time where you're seeing incredibly tight spreads in credit and where arguably fiscal stimulus, if it's continued, means actually probably growth will be pretty good?
Yeah, look, so again, when we look at the rates market, and it feels like you speak to fixed income investors over the start of the year, and it feels there's a lot of turmoil, and it's been this brutal repricing of Fed policy from 125, 140 basis points of easing to this now swing of people talking about not easing at all, and you've had that whipsaw. Yet risk assets have traded exceptionally well and have lived in their own world. And we've said perpetually in the last few months, look, credit looks rich to us, and equities look rich. However, the backdrop allows the rich to stay rich or get richer. And I think there's this like push and pull. You've had record IG supply to start the year. January's record month, February's record month, March is exceeding expectations, yet it has been digested with ease. So is there a point that there's a breaking point? So when we look at things, we're barbelled. There's some value. We have comfort in being in the front end in higher quality corporates. We are okay with, again, having a curve bias, a curve steepening bias that like we'd rather own front end paper and 2-year paper than extend and have that duration risk.
How crowded are these trades?
I think trades are, again, the consensus trades are crowded and are getting more crowded. And I think the conversation earlier about the BOJ is one of them. People are very excited about the BOJ going again, but we've seen this playbook before, and there's reason to believe that this may be the time that the BOJ engages. But I think it's a well-subscribed view.
Maybe, possibly. Everyone's on board right now. Dolly Yen with a big move in today's session. I want to finish on what we heard from Chairman Powell just yesterday, not on monetary policy, but on financial regulation. Was that a green light to keep buying the banks?
Look, I think that regulation broadly, it's been something that has been topical, and there's been so much work for the GSIBs to support that, and I don't see a pull away or a reason for concern there. Again, when we look broadly at the consumer and at growth, and I think there's a lot of diligence on the bank side from a risk perspective. So I think the financials are well supported.
That's what I'm trying to get into. JP Morgan at all-time highs on the equity side of things. When you back away from a capital proposal like the one that was on the table in the last few months, does that do anything on the debt side of the equation for the banks at all? Does it make it a better investment proposition or not?
Look, I think that the financial sector as a whole is sound, and I think that the regulations that are always proposed seem to be proposed more stringent and then dialed back. And I think that leaves the market in an okay place to digest it from where we are.
Christina, good to see you. Christina Campmany there of Invesco, following Chairman Powell day one. Day two coming up a little bit later. The next hour, just absolutely stacked. I'll go through it for you. We're going to catch up with the brilliant, the legendary Howard Marks of Oaktree, Michael Gapon of Bank of America, Democratic Representative Abigail Spanberger of Virginia. All of that still to come, Bramo. Next hour.
I'm so looking forward to that at a time where there's so many uncertainties, and so much of it is sort of confluence of the political with the markets. With Howard Marks, I want to really talk about what it means to be in a new regime of truly higher benchmark rates, right? How do you calibrate risk where there's no alternative, with people going into risk because they don't want to go into the alternative, right? I mean, this is sort of a new era of risk-taking when we haven't fully flushed out the old one.
The memo that came out at the start of this year, and there are many highlights in that memo, but one of the standout lines in there, rates aren't that high. Rates aren't that high. That's quite a line.
Basically saying, look, you go back to the other eras and you saw much higher. Also talking about the potential, he sees rates kind of 3 to 3.5% over the next decade. How does that reset everything when you start looking at a lot of capital structures? Again, are we talking about long and variable lags, or did the monetary policy just not matter?
You know when you get to the gate, or you come out the gate at the airport and you get on those walkie things that make you go quicker?
Walkie things, yes.
What are they called? Like travelators? What are they called?
Moving, yeah.
The people mover? Is that
I don't know. That basically, it doesn't make you
them?
actually a better athlete, that you're going faster.
That's the era of easy money. I love that.
I do too.
I love that.
Moving walkway.
There we go. That's next.
Welcome back to a special BNP Paribas Open update for Bloomberg TV and radio from Tennis Channel. Former world number one Angelique Kerber got off to the perfect start as she closed out Petra Martic in straight sets. The three-time major champion is returning to tennis after giving birth to daughter Liana last year. Kerber closing out her first win of the season on the WTA Tour in just over an hour and a half. Up next for her, 10th seed Yelena Ostapenko.
we've been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, you know, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood, in my mind, how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of 2 different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
This is Bloomberg.
What is performing right now in this market are companies that are putting up good numbers on earnings, that have been raising guidance, and that have very strong fundamentals.
We are seeing more than just tech and consumer discretionary work well, so that's certainly a positive.
Yes, it's a bull market, but maybe more of a duck market.
We've been in this kind of environment that you can describe as benign, disinflationary Goldilocks.
We've got a market where inflation expectations are low, so why wouldn't you be happy?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The control room insisting it's a people mover still.
It's a moving walkway.
It's a moving walkway.
But if you want to call it people mover, go for it.
I'm going with Team Bremo. Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance begins right now with equity futures positive by 0.25%. Big 60 minutes coming up. Allow me to frame the next 30 minutes or so. In about 15 minutes, we'll get jobless claims in the United States. In about 30 minutes. In 15 minutes, you'll get the ECB rate decision. President Lagarde, 30 minutes after that. So it's a big hour in the next hour.
What's interesting to me is that we're not talking about Christine Lagarde at all. Right now, the question of when they cut rates by 25 basis points is less relevant than bigger picture questions around fiscal policy, which we're going to be getting, but also this idea of the economy and whether the jobs market really is as robust as people think.
Well, let's talk about the economy. 216 is the estimate for claims in 29 minutes' time. ADP was a little softer for whatever the ADP report is worth. Looking at payrolls on Friday, the estimate is 200,000. Everything just feels in line and okay at the moment. Not boomy like it was in January January, which I guess is sort of okay for Chairman Powell as well.
Yeah, it's very difficult to understand okay. That's actually something that I was thinking about. It's really good to identify boomy or busty, but okay, is it going to tip into one place or another? What do you do with okay? This is something I've been struggling with the data coming in. Okay, tipping a little this way or a little that way. Where do you get conviction at that point?
Kit Jukes of SocGen has this to say: wait for tomorrow's payrolls figures. If they're weak, I'll be more inclined to see the strong data for January as a curveball. If they're strong, I'll expect forecasters to rethink the Fed all over again. That was why the February data was always going to be important. Does it double down? Does it reinforce what we heard at the start of the year?
And what are the revisions like? That's something else that people keep talking about. They come up with projections, then you get the revisions, and then they got to completely reassess. It's a tough market to get right. The anecdotal data, again, it's okay. It's not boomy. It's not busty. At this point, where do you get conviction?
Equity futures right now, okay, not boomy or bust. I'm going to use that all day now. Equity futures right now, positive by 0.2%. Here's a flavour of financial markets for you. In the bond market, yields a little bit lower by a single basis point, 4.09%. It's Chairman Powell, day 2 on Capitol Hill, yesterday in front of the House Financial Services Committee, a little bit later on this morning in front of the Senate Banking Committee. In the bond market, then, yields basically unchanged, down a single basis point or so. In foreign exchange going into that ECB decision, 108.94 on euro dollar, just a slightly weaker euro, slightly stronger dollar. Coming up this hour, the brilliant, legendary Oaktree's Howard Marks on why we're unlikely to see a return to easy money anytime soon. Bank of America's Mike Gapin looking ahead to the payrolls report, and Congresswoman Abigail Spanberger previewing the State of the Union. AMH down in Washington, D.C. We'll catch up with Anne-Marie in just a moment. We begin this hour with our top story. No news is good news. Stocks edging higher as Chairman Powell tells Congress he's expecting rate cuts this year, even as a strong economy keeps the Fed on hold for now. Oaktree's Howard Marks writing this in his latest memo: I find it interesting that the current stock market rally began as a result of optimism powered by consensus thinking that was generally off target. Investors motivated by their belief that the Fed would pivot to dovishness and start cutting rates in 2023. That was wrong. We'll get into consensus in just a moment. The legendary Howard Marks joins us around the table. Howard, good morning to you.
Good morning, Jonathan.
Fantastic memo. Really enjoyed the read earlier this year. Easy money. You reflect on the easier times fueled by easy money, lulling investors into a false sense of intellectual superiority. I want to know, and I think Lisa wants to know too, have we fully realized the pain associated with some of the loans, some of the things we did 10 years ago?
No, clearly not. It's early. The economy is still good. That keeps shaky loans aloft. The maturities, you know, any company that was not asleep at the switch pushed off its debt maturities in 2021, 22, when rates were still close to zero, pushed them off. So the maturities start for real in 25. There are not substantial maturities this year. And, you know, there are 3 ways you can default. You can breach a covenant that specifies levels for your financial statements. You can fail to make an interest payment, or you can fail to meet a maturity. Well, the eager lenders let companies exclude covenants in recent years, so you can't do that. Interest rates mean that the coupons are low, interest coupons are low, so it's hard to miss one of those. And in a positive climate, you can borrow to make your interest payments. So we're really talking about maturities which have been pushed off to next year. And if you get maturities spiking in a weak economic period or weak for certain groups, that's when you get defaults. They're still running low.
A lot of people have come on this show, Howard, and said that this market is discerning. It's not necessarily just buying everything with abandon. It isn't exuberant. There isn't euphoria. There's sort of a separation of those zombies or those that are likely to default in 25 that can't survive until 2025 and those that can't. Do you agree with that?
I generally do. You know, this is not... The crazy markets are few and far between. When you get a real soaring bull market, a bubble, or a crash, those are when they stop being discerning and, as we say, throw out the baby with the bathwater. Most of the time, markets are sane, especially a market like this, which is being buffeted by good news and bad news at the same time. So, yeah, I think we're in the middle ground. I've been saying for a long time that we're in what I call the zone of reasonableness, and I don't think there's anything much to do.
zone of reasonableness, and I want to get into that there's not much to do, but a zone of reasonableness where there's a strong consensus, and you pointed to, and John led with, this idea that consensus last year was completely wrong. So this year you said there's a feeling that smacks of Goldilocks thinking. How do you work with that as an investor?
Okay, I don't think the consensus is necessarily not wrong. I just think that most people can't improve upon it. That's really the criterion. You know, what I learned in school, the efficient market hypothesis, markets are efficient. That doesn't mean they're right. That just means that most people can't improve upon the market's consensus judgments. So now tell me your question.
Well, I guess that I'm wondering, where are we in the cycle, in the credit cycle?
Well, following from Jonathan's question, you know, Buffett says it best: when the tide goes out, we find out who's been swimming naked. The tide hasn't gone out. We're still in generally salutary period. Economy functioning well, earnings pretty good, interest rates coming down recently, money available. So under those conditions, you don't have a test. The question is, which companies and industries do okay when conditions get tougher?
Can we work through some of the more quotes in this memo as well? There's this great line, and you've said it's an old line, but I still love it. The worst of loans made at the best of times. Yeah. This quote from you: I love Hayek's word malinvestment because of the validity of the idea behind it. In low return times, investments are made that shouldn't be made. Buildings are built that shouldn't be built. Can we talk about buildings that were built that shouldn't have been built? Is that an area of focus for you at the moment as you think about prospective weakness down the road?
Well, I think that commercial real estate, office buildings in big cities in particular, are a focus area for investment people. The post-pandemic behavior of people not going to the office so regularly calls the sector into question, as does AI and the question of how many employees you know, you're going to have. Or am I going to be talking in 5 years to a machine over there? I don't know.
Maybe you are right now.
There you go.
Maybe this is AI right now.
Lisa topped me as always. But so I mean, there are questions about real estate. But on the other hand, most people won't touch real estate with a 10-foot pole, and they may be underestimating the intrinsic value. So that, you know, Jonathan, it's important that everybody understand. The question is not, is everything going great in a sector, or is it going terribly in a sector? The question is, do prices in that sector reflect the reality, overestimated or underestimated? I've made a living buying things that nobody else thought was a good idea, but if you buy them cheap enough, they become a good idea. And, you know, if you have the right real estate in the right place, if you're differentiating and other people haven't,
yep,
then that's a time for bargain hunting.
So you've got the story and the price of the story. Can I ask if you like the price of the story?
You know, there's not a lot of price discovery going on in the real estate industry. There are very few transactions. So when you say, do I like the price of the story? I don't see a lot of prices. In order, you know, I see, people say, it's not worth anything. But where will they trade? If the quoted price for a New York office building is down 50%, let's say, will any sellers sell there? Will all the buyers buy there? If a lot of people are willing to buy and nobody's willing to sell, that says to me the real price isn't down 50. So we have to have price discovery.
Which it brings us to kind of the fact that the tide hasn't gone out yet.
Exactly.
And that when the tide goes out, then we're going to start to get some real price discovery, because then there will be some people left naked. You don't like to make rate projections. You do have a model roughly in your head where you say in the memo that you don't think that rates are high. They're kind of more normal.
They're not high relative to my experience.
So if that's the case, you kind of game out a 3 to 3.5% Fed funds rate over the next 5 to 10 years. What then does that mean for returns just more generally? Does that mean that they're better in credit and better in your world, or are they kind of worse because the overhang that we've had of the easy money policies is going to take a lot to work through?
Well, it's a complex question, but those, you know, we're at 5.25 to 5.5 on the Fed funds rate now. That's a measure determined to crimp the economy to kill off the excess inflation. The target is 2. We're above 2. Cool off the economy until it moves toward 2. By the way, in Powell's remarks on Monday, he said, we won't cut rates until we see we're making progress toward 2%. I thought that the word toward was very important. He didn't say until we're at 2%. So I think that, you know, if inflation starts going, you know, 3, 2 3/4, 2.5, maybe he'll start cutting. I don't know. But the word toward was important. The only thing I'm sure of is that if interest rates are higher, the people who invest in credit instruments, which is what we do, are buying in at higher yields and invariably will have higher returns than they have in the recent past. So today's rates are not high historically, but they're certainly higher than we had from 09 through 21, which means the returns on credit investing, fixed income investing, bond investing, loan investing, will be higher than those in that period, which were, you know, really paltry.
Howard, always super thoughtful. I'm pleased to say you're going to be sticking with us. We've got a central bank decision to get to as well, the brilliant Howard Marks. I want to get you an update on stories elsewhere too. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. NYCB is offering new details after yesterday's equity investment of more than $1 billion. A statement says Liberty Strategic Capital and other partners are making individual investments rather than a combined investment. The bank will also sell nearly 60 million shares of common stock and 192,000 shares of a new series of preferred stock. Yesterday, NYCB raised more than $1 billion from investors. That included the former Treasury Secretary, Steve Mnuchin. Congress may be taking another step to crack down on TikTok. Today, the House is expected to take up a bill that forces ByteDance to sell the app in 165 days. If it doesn't, the U.S. would ban TikTok from app stores. The Biden administration has backed the idea, but hasn't fully supported the exact legislation yet. The latest ECB decision is due in just a few minutes. Allianz chief economist Ludovic Sabran told me earlier on the brief that the central bank will find itself in a pickle this year if it ends up cutting rates before the Fed does likewise.
The big issue is what happens if the Fed doesn't cut at all this year. That's the big issue. And this would be horrible for the ECB because we're a financial obligé. You know, I mean, whatever happens in the US has to set the tone to what happens in Europe. There's not like, you know, the ECB being all of a sudden, you know, in the lead and not a laggard. We cannot do that. The financial flow risks are too high.
ECB President Christine Lagarde's news conference begins at 8:45 a.m. Eastern. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. An ECB decision just moments away.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
From New York City.
In London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Breaking news just moments ago, ECB rate decision, no change to interest rates, but as expected, slightly lower in forecast for inflation. Mike McKee has the details. Hey, Mike.
John, it's actually a fairly steep reduction for the ECB, down to 2.3% for this year, as opposed to 2.6% in their last estimation. They also take down their forecast for 2025 to the target of 2%. 1.9% in 2026 as they're forecasting an overshoot. They're also looking to see growth slow significantly this year, just a 0.6 gain in GDP for 2024, and they expect growth to pick up a little bit, but only to 1.5% in 2025, 1.6% in 2026. This is the kind of numbers that we've been told to look for from Christine Lagarde when she starts talking about when they might cut rates. They may be ahead of the Fed because inflation's moving down more quickly and growth is slowing there. We got some bad news out of Germany today with their industrial production manufacturing down 11.3% in the prior month.
We've had tons of bad news out of Germany.
That's true.
On the continent, the euro right now is slightly negative on the session, 108.81. Just a programming note, that news conference will begin at 45 minutes past the hour. So we'll bring the headlines from that ECB news conference in just a moment. We have around the table with us the brilliant Howard Marks of Oaktree. Howard, I want to start with this, and it's a question I know you're keen on answering. How relevant are these decisions? The ECB today, the Federal Reserve later this month, the BOJ, how relevant is all of that to you and the team?
Well, you know, a year and a half ago, Jonathan, I wrote a memo called What Really Matters. And I started off by listing 5 things that, in my opinion, don't matter, the first of which was short-term events. So, you know, if I tell you there are going to be 5 rate cuts this year, what will you do in your portfolio? And if I say, oh, no, it's going to be 3, what will you do different? If I say the first rate cut will come in May, what will you do? If I say July, what will you do different? And these things don't matter. They preoccupy us because, you know, the real movie that matters runs so slow that people have to find something to do in the meantime. But, you know, what matters is the direction of interest rates over the next 3 years, the direction of the economy, the growth rate. For me, as an investor, what matters is, do I lend money to companies that pay me back? Not what the profits will be next week or month or quarter. For the stock investor, it's, are you investing in companies that will prosper over a multi-year period? That's what matters.
So I will just say that we do talk about it every day because we have to talk about something, and the slow-moving, you know, sort of long-term story doesn't always fly when we're coming up with everyday news. But there is this question about when the cutting cycle matters in terms of going into Europe, for example. Does that affect your investment thesis if you have an ECB willing to ease policy in the face of real weakness, or are you just looking at strength and pockets of opportunity?
Well, that goes to the question of secularly, that is, over time, will the European economy be strong or weak? And it's clear that they believe that the growth over there will be quite anemic. That's important to know. Now, Oaktree does not make investments on the basis of macro forecasts. In other words, what we care about is, if we lend to a company, will they pay us back? Not what will GDP growth be in 2026, according to Mike, according to Lagarde. You know, look, Europe is weaker than we are here, and that's the important thing. Will that be realized? Will the expectations for the U.S. of I would say, more than 2 growth be realized? These are important. The other thing I know for sure is that I don't know. And, you know, nobody at Oaktree knows more than the consensus about these matters, and that's why we don't make our investments predicated on these matters.
When you're going in, though, and you're looking specific company by company in Europe, Do you see a lot of opportunities from companies that aren't as crowded as, say, in the U.S., where everyone's banking on the strength story?
Yeah, well, that's the other hand. You know, on the one hand, we know their economy is not as good as ours. On the other hand, maybe the investments are correspondingly cheaper. So that's why we can't. Nobody should invest on the basis of a single factor, like the rate of economic growth. It's always Jonathan's question: do you like the price, and do you like the growth rate and the price relative to the growth rate and the price someplace else? So that's if we earn our livings, that's how.
Can we finish on leverage and where we are in the cycle? This great line in your memo, the mother's milk of rapid expansion and speculation. If we reflect on the last, let's say, 10, 14 years, you would imagine that in a decade-long period of ultra-low interest rates, you would have had this explosion in leverage. There are several reasons for that. But this period's been quite odd because we then had the pandemic, which led to the strengthening of balance sheets for both corporates and households off the back of a monster fiscal transfer. And a question I think that Lisa and I hear a lot, Howard, is where is the leverage now? Where is the leverage now?
Well, we know that the leverage is in the government, that the government has taken on a lot of leverage as part of its rescue mechanism. We had two serious problems: the global financial crisis to kick off that low rate period you're talking about, and then the pandemic to bookend it. And in both cases, the Fed discovered something called quantitative easing, or the buying of bonds, and it really did a great job of saving the economy on both occasions, but it loaded up its balance sheet with debt. And you know, corporate balance sheets are generally okay. If you look at leverage buyouts, which is something that's very important to us, the leverage on those is lower than it historically has been. In the 90s, it was 70-75% debt, 25% equity in most companies. In the 80s, it was 95-5, and today it's more like 60-40. So the companies themselves are generally less levered.
Is it too simplistic to say if the increase in leverage has been on the sovereign balance sheet, that's where the risk is? How do you frame that? How do you think about that?
Well, first of all, I don't invest in sovereigns. And the trouble is that in sovereigns, other things matter. You know, they don't. When we look at companies, we ask, do they make money? Will they make money? Will they be able to pay their debt?
Yeah.
Governments don't make money. They're not expected to make money, and they pay their debt by running the printing press. So that's a very different function.
And then they have the ability of extending the cycle at the same time. I think this is what I'm trying to get my head around. If they've absorbed basically the leverage that existed elsewhere, and they are less exposed to the challenges of companies that you would invest in, are you thinking of a much longer cycle as a consequence?
Well, I don't think governments can keep us aloft forever, you know. But and then the other question is, are the currencies acceptable to the world and at broad price? You know, an exchange rate is a price. The dollar euro exchange rate is the amount of dollars that people will pay to get a euro. And if that goes off the rails, then maybe they can't print as much or have other indigenous problems. So again, multi-factor, not one.
Which is why we talk about the euro every day, Howard. This is great.
Thank God.
Howard Marks of Oaktree. Howard, you're just one of the best. We appreciate it. Thanks for giving us so much of your time, sir. The euro right now, negative by 0.1%, 108.84. I feel terrible doing this now with Howard sitting next to me. Traders effectively betting on more cuts from the ECB off the back of these forecasts from the central bank.
Look, it matters to a lot of people, and I will say this, it depends on whether they see that weakening in the economy as coming along with the inflation coming down. I want to hear from her about the Houthi attacks and what that's going to do to potential
Good point. Pressures. A lot of questions, I imagine, on that story. ECB President Christine Lagarde, that news conference starting in about 20 minutes' time. There is a bid in the bond market. Treasury yields a little bit lower off the back of that decision. We'll catch up with Michael Gapin of Bank of America in just a moment. Michael McKee is going to break down jobless claims for you. All of that coming up next.
EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
Got some economic data in just a moment. Jobless claims. Mike McKee is going to break them down for you. Equity futures right now positive by 1/3 of 1%, up 0.5% on the NASDAQ. If you look at the bond market, there's a rally here. Yields are lower now in the US by, let's call it 3 basis points, 4.07%. In Germany, we're down 6 basis points at 2.26 off the back of the ECB's forecast. Inflation lower than expected. Does that open the door to rate cut to the ECB sometime soon? The euro lower, negative, weaker euro, 108.83. With those jobless claims data and a whole lot more, here's Mike McKee. Hey, Mike.
John, we've been talking about a lot of layoff announcements coming through the news, but it's not showing up in the numbers. Only 217,000 jobless claims last week. That compares to revised 217 the week before. Had initially come in at 215, so no real change there. The number of people who are still getting claims, 1,906,000. That's up from 1,898,000, which is a revision a little bit lower. So the continuing claims numbers not really telling you anything different either. The length of time people are taking to get a job hasn't changed significantly. The other big news of the day, the trade balance comes in unexpectedly high at $67.4 billion instead of $64.2 billion. So that's going to be a subtraction from first quarter growth. This is the first January number we have on it. So a little bit of a surprise there. Productivity and unit labor costs, their third revision productivity is unchanged at 3.2%, and the unit labor costs come in a little bit lower, 0.4% from 0.5%. The productivity numbers are interesting, not necessarily because they changed at all, but because they have been so high. It's been one reason that inflation's going down here, and it is a big difference between what's happening in the U.S. and what's happening in Europe, where they have about 0.6 productivity. So it shows you one reason why maybe our yields are going to stay a little bit higher and our economy is going to grow a little faster.
Hard to get a clean read on the price section off the back of this, because this economic data that just came out is in combat with what we've just heard from the ECB and the forecast for inflation. This is where we stand. Equity futures positive by 0.4% on the S&P 500, on the NASDAQ 100 up by 0.6. In the bond market, yields were down by, let's call it 2 basis points on a 10-year going into that jobless claim figure, now down by 3 to 4.0691% on a 10-year maturity. On a 2-year, 4.52, down by 3 basis points. Lisa, if I was to put it all together, just looking at the jobs data, just in terms of the market reaction to it, this is just another one in a list of them now so far this week where in line or downside surprise is good news. And it was the same as PC in the last week, by the way, as well. It's the absence of blowout beats like the ones we were getting in January that I think encourages this market just a little bit more.
It's the absence of the tail risk of a potential reacceleration in growth and therefore in inflation. If you don't get that, that is considered a very positive thing for this market. I will just say, though, to Mike's point, there's a real question here, especially with the ECB coming out and projecting weaker growth and weaker inflation. Does the U.S. stand alone, or is it kind of together with what the ECB does and with the Euro region? And the reason why I ask is because bond markets are very much trading in tandem still, even though we keep saying the U.S. economy is doing a lot better and has a lot more momentum.
First question you ask in this news conference today, why haven't you just cut interest rates? Isn't that the question you ask in about 12 minutes' time based on what they've just told us?
Absolutely. If you are projecting lower growth, if you see recession in Germany, if you see inflation coming under control, what's holding you back right now?
Mike McKee, what would you ask in that news conference? Take your Federal Reserve chops over to the ECB. What would you say?
Well, I think that's a good question about timing, because the ECB sees momentum that is perhaps stronger than the Fed, down towards 2%, and they're anticipating they get there sooner. And so they could move now, and that might be something that could give them a little bit of a tailwind at a time when the U.S. is lapping them. The futures prices now, swaps are pricing in basically a move in June for the ECB from July, but the Fed is still out there in July. We'll see what happens after tomorrow's jobs report.
Yeah, and what happens today also at 10 a.m. when we do hear for day 2, Chair Powell on the Hill.
I don't think you get much there.
Well, maybe not, but I do think it's telling that the enthusiasm we're seeing in the equity markets and bond markets hasn't shaken this feeling that there are going to be cosmetic cuts or trimming around the edges later this year. What are you looking to hear from him today?
Well, what I would like to hear from him is a little bit more on the criteria that go into when they cut rates, and try to get a feel for this whole idea of whether they cut this year or not. But I think what we're going to get is pretty much a reiteration of what he said before. There's unfortunately nothing in it for him to answer my question.
Day 2 on Capitol Hill. Mike McKee, thank you, sir. Chairman Powell in front of the House Financial Services Committee yesterday, in front of the Senate Banking Committee a little bit later, and I guess the highlight of that might be Senator Warren coming up a little bit later, and not on monetary policy. We've already heard what she thinks about that. Cut interest rates right now. It's got to be financial regulation later this morning.
Why are you taking away our gateway to protection against the largest banks? You should be increasing some of the capital holding, not taking it away. I'm curious about whether he walks back some of his proclamations from yesterday, given some of the criticism that maybe he was front-running his compatriot Michael Barr from the Vice Chair of Supervision.
It's an interesting question. Mike Gapen with us now, Bank of America. Mike, don't worry. We're not going to talk about how happy Brian might be with that move from Chairman Powell yesterday. I want to talk about monetary policy with you. The ECB opening the door to a rate cut in many ways. That news conference is going to start in just a moment. Can you frame the differences between what they're looking at the moment over in Europe and what you're looking at over in the United States for the Federal Reserve?
Yeah, I would just say as a policymaker, it's a lot easier to justify action if growth is slowing that meaningfully, right? So if inflation's coming down and growth is weakening, it's obvious. Then it is about timing, not necessarily direction. In the US, it's a different story, right? The direction of travel has been towards firmer growth and then questioning, well, how quickly does inflation come down? So the Fed says that narrative, where most of this appears to be supply side driven, suggests we can ease later this year. But then there's caution and balance of risk. So it's a little trickier, requires more nuance from the Fed.
We know why there's caution, because we just had this really boomy data to start 2024. Right. So far, it doesn't look like February is confirming January. Are you expecting that from the payrolls report tomorrow morning?
Yes, in the sense that I don't suspect we added 350,000 jobs in January. I do think some of the seasonals have been slow to catch up. So there's some noise, some signal. I don't think it was a weak number. I think the labor market probably held up just fine. We're a touch stronger than where consensus is at 215,000, but that's about in line with what the 6-month average has been. So I think that the December-January turn had a lot of noise. I think the February data is saying, yeah, things are cooling on the margin. Don't look for reacceleration. So as you said, Lisa, that's kind of the big narrative driver. Are we reaccelerating or just showing resilience? We're in the latter camp.
So what would it take for you to enter the camp that we've been talking about, which is the no rate cut camp, which is getting bigger and is actually attracting more and more?
Yeah, so I think you'd need a number closer to January, and probably at least above 250. Maybe closer to 275, but I think it would have to be accompanied with other information like wage growth is picking up, the decline in hours worked has reversed. So I think you need some more context beyond just the employment number. But yes, something like that would probably reduce odds in June substantially. And the trick there is that there are some in the market who say, well, if the Fed doesn't move by June, they're not going to move this year. So you could see kind of a peeling off of rate expectations very quickly. If you take off June, some in the market may be inclined to take off September as well.
Last night I was going through the data. I was going through Quits data from Jolts. I was going through a whole host of others. And I was struck by the narrative roulette we've experienced over the past year or two. And this idea that we can't get our heads, or I can't get my head around, okay data that doesn't really have a direction, that sort of is good enough, but doesn't really suggest what's going to happen in the future and is messy. What do you make with data like that?
Yeah, I would say that from the economist point of view, I would say, I'd add, and if it's a lot about a supply shock, you get reactions that look different than you're accustomed to. Meaning we usually think, oh, strong growth leads to overheating effects. And we're wary of that, and we're concerned about that. But over the last 1 to 2 years, it's been the opposite, right? So it's a world where we can coexist with strong growth, low unemployment, declining inflation, right? We're not used to that. So the data being okay, we may not have a reaccelerating story, but it's still one that's tricky to navigate.
Right now, when you look forward, what is going to be the key data point that's really going to drive some of your forecasts as everyone seems to be climbing on the Goldilocks scenario?
I would still say the two most consistent data points, the December to January turn aside, is the employment data and the inflation data. Seasonally adjusting a $27 trillion economy through a pandemic, really hard, but it's got to be easier to count. Got to be easier to count people in seats and what we're paying for things.
CPI next week. Best guess. Where are we a week from now? We've got payrolls in hand. We'll have CPI in hand. We will have just got retail sales as well. Where do you think we'll be? How would you describe that moment?
Labor market holding up, but cooling on the margin only a bit. We think core CPI will come in at 0.3, so maybe alleviating some fears of reacceleration. Our credit and debit card data suggest retail spending is softening. So again, probably okay, falls into Lisa's okay description.
Yep.
I think on net, that's where we'll be.
I think probably okay is probably what this equity market wants, right?
Oh, okay is perfect.
Probably okay.
But as long as it's okay with the look forward, that it will continue to be okay, right? I mean, that's sort of the key question, is what's our look forward when you have okay that's kind of messy?
Isn't that more good data? Isn't probably okay, Chairman Powell's more good data? Isn't that right?
That's what they want to see. He said it doesn't have to be better. It just has to be continually good. Interesting, though, when we say 215 is not that great, you know.
I know.
2 months ago, we were talking about 180 as being a strong number. So okay has a different definition these days.
Well, remember a few months ago, we thought we'd get rate cuts in March, and here we are. It's March. Mike Gapon, good to see you. Michael Gapon of Bank of America. In the FX market, just want to bring your attention to what's happening with the euro at the moment. The euro is negative by 0.2%. It's 108.76. There is a bid in the bond market down 4 basis points on a 10-year treasury. Over in Germany, the bid a little bit larger, yields are down by 7 basis points to 2.25. A big focus on the ECB, maybe Bramo cutting a little bit sooner off the back of those forecasts.
And a little bit more, now talking about 100 basis points of rate cuts, which raises this question, what does that do for the euro trade, given the fact that we're talking about the potential for the Federal Reserve pushing back all of those rate cuts? All of the people who came on and said the consensus was the ECB would cut rates first, it's looking more and more like they're right.
This is the FX market you'd be excited about. If we can push the Fed out a little bit further, bring the ECB in, pump up how many cuts we get from the ECB, reduce them from the Fed, you've got a little bit more of a trade there.
You would think, right? And that would think, well, that would be quite a bit of dollar strength, considering the fact that you're also having a stronger than expected economy in the U.S. So it's surprising to me that there isn't more of a response, frankly.
That news conference with President Lagarde starts in about 3 minutes' time. Let's give you an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. One of the world's biggest ship crew unions is urging all vessels to reconsider sailing through the Red Sea after yesterday's deadly attack from Houthi militants. Nautilus International, which represents 20,000 workers, says the utmost priority should be safeguarding the lives of seafarers. The death of 3 crew members marks the first loss of life since the attacks began last November. Donald Trump wants to debate Joe Biden. The former president posted on Truth Social, "I'm calling for debates anytime, anywhere, any place." Trump skipped the debates during the Republican primary. A Biden campaign spokesman says if Trump is desperate to see the president primetime, he can watch a State of the Union tonight. Shares of Novo Nordisk gaining after the Dutch drug maker released promising data on an experimental daily weight loss pill The company says the new treatment helped patients shed 13% of their weight over 12 weeks use. In a meeting with investors, Novo said the study was small but provides a basis for further development of the pill. And that's your Bloomberg Brief. John.
Danny, thank you. Up next on the program, President Biden charting a path forward.
Americans are very fed up and frustrated with Washington for a whole slew of issues. President Biden is going to try today to present himself as a problem solver who's been adept at addressing some of those issues despite the dysfunction.
We'll head down to Washington, D.C. and catch up with Anne-Marie in just a moment. Equity futures are positive by 0.4%. Your opening bell is just around the corner.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
On Bloomberg, your global business authority.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders.
Watch Wednesdays on Bloomberg Television.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Venice this morning, President Biden charting a path forward.
This is probably the most important speech he's going to give the American people. President Biden right now is historically behind every single president except President Carter on 5 to 6 of the most critical metrics. Americans are very fed up and frustrated with Washington for a whole slew of issues. President Biden is going to try today to present himself as a problem solver who's been adept at addressing some of those issues despite the dysfunction.
Here's the latest. The president delivering his State of the Union address tonight. Biden expected to defend his foreign aid and border policies and handling of the economy. Voters watching not only for what he says, but how he says it, as concerns about his age and mental acuity mount in the polls. Anne-Marie back with us down in Washington. AMH, just how big is this moment for the president?
Well, everyone in Washington is really calling this the most important speech, Jonathan, of his presidency, but not just because it's a normal State of the Union in sense of constitutionally he has to give this report to the American people, but also this is a campaign speech. He is obviously going to be trying to differentiate himself from former President Donald Trump and why he thinks the American people should give him 4 more years. You know, we heard from Mohammed Yunus there, and he was saying that his approval rating right now is low in the Carter world. A line that I keep hearing from both Democrats and Republicans is what Reagan said about Carter. Are you better now than you were 4 years ago? Well, how Biden is going to talk about that today is going to be trying to remind the American people where they were 4 years ago, March 2020, when the world shut down in COVID. And now we actually are joined by Congresswoman Abigail Spanberger of Virginia, a Democrat representing a swing district, not just a swing state, and also a candidacy for Virginia governor. Congresswoman, thank you so much. I want to start in Virginia. Trump obviously won the primary there, but Nikki Haley had a pretty strong showing in Northern Virginia. And what we know from the Biden campaign is that they want to welcome these voters. How does he speak to those voters today? More moderate-leaning Republicans or independents?
Well, it wasn't just Northern Virginia. It was Williamsburg, it was Charlottesville, it was Albemarle County. There are pockets throughout the Commonwealth of Virginia where we did see that Haley did well. And I think the way that the president speaks to all voters, all Americans, is by talking about what our vision, our shared goals are. I want to hear the president talk about the issues that are front of mind for so many Americans, and certainly, you know, that begins with our fundamental freedoms, specifically abortion rights and reproductive rights after what we saw the Supreme Court in Alabama do. That's front of mind for so many voters, certainly across Virginia. I want to hear him talk about the concerns that so many people have across Virginia about fentanyl and the immigration challenges, the need for border security and immigration reforms. Certainly front of mind is the issue of national security and whether we will be able to move forward with Ukraine and the national security supplemental. And then ultimately the day-to-day challenges facing so many Americans, costs, mortgages, home rental prices, costs at the grocery store. These are the things that are top of mind for so many people across Virginia. And I think if the president's speaking to those things, not only will that be potentially positive and inviting messages for those who already rejected Donald Trump at the ballot box by voting for Nikki Haley, but also an important message for all Americans.
Well, poll after poll continues to show that voters actually think Trump would be better when it comes to handling some of those issues you just outlined. In 2021, in the New York Times, you gave this quote, "Nobody elected him, Biden, to be FDR. They elected him to be normal and stop the chaos." Do you think he's become more normal, in your words, over the course of his presidency?
Absolutely. You know, I have 3 school-age children. One in elementary school, one in middle, one in high school. And what I know is that now we are back to putting our kids on the bus. We are not worried about a global pandemic. We are not worried about the shutdowns that we saw in early 2020 and into 2021. In fact, we are back to some level of normalcy that so many Americans felt. There is so much room to make continued improvements and continued progress. But yes, I do think that actually the president settled into what I do continue to believe was his mandate, which was to settle things in the aftermath of the pandemic and get back to governing. Now, the fact that Congress isn't always a willing partner and the Republican majority in the House is not always a willing partner, that's an entirely separate issue. But in terms of being a steady hand, in terms of demonstrating the level of normalcy and the calm from the chaos that was the entirety of Donald Trump's 4-year presidency, I think that President Biden has done a very strong job and followed the mandate that I think he was sent to Washington with.
You mentioned immigration as a top issue. Gallup polling shows that now, since 2019, it is the top issue on American voters. You were a former intel officer. You dealt with some of these drug cartels. Is this problem worse than ever before you've seen, given your intel background?
So I think there's multiple factors here. You know, certainly there is the issue of drug trafficking. There's the strength of drug and transnational criminal organizations. And as you mentioned, I'm a former CIA officer. Also before that, I worked narcotics and money laundering as a federal law enforcement officer. So there are elements of the challenges that we face, the larger scale kind of international issues, but then the reality that we as a nation have an immigration system that is not working. It is outdated. It has not been been reformed in a generation. And we see that day by day when people are coming to the United States and rightfully, as is their right, trying to apply for asylum, but the backlog and the wait is years and years and years. I have farmers and producers and industry across my district that want to hire workers from abroad, hospital systems that want to bring in nurses and doctors, farmers that want to hire. We need real reforms.
But barring that reform, should Biden use his executive authority and shut the border?
I think at this point in time, the president should be looking at pursuing any and all authorities that are within the realm of possibility for the president. But we have to be clear about why we are talking about the president taking executive action. There is a need potentially for the president to use every tool in his toolbox, because when Democrats and Republicans and the White House engaged and worked for months to pull together a bipartisan, policy-focused bill that would reform our immigration system and make substantial and comprehensive immigration updates to our border security protocols and policies, and that was brought to the United States Senate, initially viewed as a tremendous success, and my hat's off to the Republican senators who worked on that with Democratic partners and the White House. Immediately, former President Trump signaled that he didn't support it. Speaker Johnson said it would be dead on arrival in the United States House, and they crushed any and all hopes of what would have been a monumental step forward in policymaking. And so it is within that construct that we are now talking about potentially what sort of scratches at the surface exists within the president's toolbox, because the folks in this building and the Republican majority and Speaker Johnson refused to take meaningful action. We are here to govern and legislate, and they are refusing to do it.
Congresswoman, thank you so much, Tom. We really appreciate it. Congresswoman Abigail Spanberger of Virginia. And Jonathan, she represents a swing district, and also, if she was able to win the governorship of Virginia, she'll be representing a purple state. So she's been one of those individuals that within the Democratic Party has been very vocal. That 2021 New York Times quote stands out to me. No one elected you to be FDR. They elected you to be normal, and she thinks he settled in to normalcy.
I remember that piece. MH, thank you. Great work down in Washington. That State of the Union coming a little bit later on this evening. Coming up tomorrow, CFTC Commissioner Caroline Pham, JP Morgan's Priya Misra, former Fed Governor Betsy Duke, and Libby Cantrell of PIMCO. We'll be speaking to Mohammed Al-Aaron as well on Payrolls Friday. We can now head over to Frankfurt, Germany. The ECB President Christine Lagarde driving through her opening statement. The Q&A about to begin in just a moment. Let's take a listen.
And the tragic conflict in the Middle East are major sources of geopolitical risk. This may result in firms and households becoming less confident about the future and global trade being disrupted. Growth could be higher if inflation comes down more quickly than expected and rising real incomes mean that spending increases by more than anticipated, or if the world economy grows more strongly than expected. Upside risks to inflation include the heightened geopolitical tensions, especially in the Middle East, which could push energy prices and freight costs higher in the near term and disrupt global trade. Inflation could also turn out higher than anticipated if wages increase by more than expected or profit margins prove more resilient. By contrast, inflation may surprise on the downside if monetary policy dampens demand more than expected, or if the economic environment in the rest of the world worsens unexpectedly. Financial monetary conditions now. Market interest rates have risen since our January meeting, and our monetary policy has kept broader financing conditions restrictive. Lending rates on business loans have broadly stabilized, while mortgage rates declined in December and January. Nevertheless, lending rates remain elevated at 5.2% for business loans and 3.9% for mortgages. Bank lending to firms had turned positive in December, growing at an annual rate of 0.5%. But in January, it edged lower to 0.2%, owing to a negative flow in the month. The growth in loans to households continued to weaken, falling to 0.3% on an annual basis in January. Broad money, as measured by M3, grew at a subdued rate of 0.1%. So in conclusion, the Governing Council today decided to keep the three key ECB interest rates unchanged. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. Based on our current assessment, we consider that the key ECB interest rates are at level that, maintained for a sufficiently long duration, will make a substantial contribution to this goal. Our future decisions will ensure that our policy rates will be set at sufficiently restrictive levels for as long as necessary. We will continue to follow a data-dependent approach to determining the appropriate level and duration of restriction. And in any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term target and to preserve the smooth functioning of monetary policy transmission. So we are now ready to take your questions.
Thank you, President Lagarde. And the first question goes to Annette Weisbach of CNBC. Annette, please.
President Lagarde, thank you very much for answering to my question. First question would be on the more abrupt revision of inflation than expected. How does that translate in the rate outlook? And my second question would be more on the discussions you've been having inside the Governing Council. Have you also discussed perhaps do too much, and by that risk that inflation is going to undershoot the target at some point in time? Thank you.
Thank you very much for your question, and allow me to preface my response to your question with something that we discussed, which is a little bit unrelated to monetary policy this morning, which has to do with the topic of concern to many European institutions, which is the Capital Market Union. So, as some of you will remember, the Governing Council had taken a view on Capital Market Union back in 2020, when the Commission had published its action plan at the time. And given the momentum and the special efforts deployed by the euro area, deployed by the Commission to progress Capital Market Union, we have decided to update significantly that statement, and we have unanimously agreed on a new statement which is more specific, which sets out the imperative of moving fast and making progress. So that statement will be available before close of business today, but will come after all the monetary policy documents are actually made available, so that we don't mix the two of them. But it was a decision that we made after a good discussion on the matter earlier yesterday and a little bit this morning. So, on inflation, first of all, I would observe that we are on this disinflationary process, and we are making progress. You know, we came from 2.9% in December, 2.8% in January, 2.6% in February. So there is a definite decline which is underway, and we are making good progress towards our inflation target. And we are more confident as a result. But we are not sufficiently confident, and we clearly need more evidence, more data, and we know that this data will come in the next few months. We will know a little more in April, but we will know a lot more in June. So this is really what we have determined during our discussion this morning. And as usual, we have proceeded with a review of the three criteria which is, the inflation outlook, which, as you will have noted in the monetary policy statement, has been slightly revised, a bit more for 24, granted, but slightly both for headlines and core in the next 2 years, 25 and 26. But we feel more confident about those projections. The second element that we look at, as you know, is the underlying inflation. And on that front as well, we are seeing a narrowing of the range between the various measures that we use. We are also seeing a general moderation, with one exception. I'll come back to that if you want. We have looked carefully at the strength of monetary policy transmission. Those are the three components that we are very keen to check carefully and to monitor meeting by meeting to see what information it delivers. And it's clearly a positive signal, but certainly not enough of a series of signals to make us confident enough yet at this point in time.
Thank you, Madame Lagarde. And the next question goes to Alexander Weber of Bloomberg News. Alexander, please.
Thanks a lot for taking my question. Just a follow-up, since you said you will know a lot more in June. Was this the majority view in the Governing Council that you will not have enough information in April to be ready for an interest rate cut? And then secondly, you're clearly very focused on wage growth. Can you be a bit specific how much further it needs to slow down for you to be comfortable with an interest rate cut?
I think there was general broad agreement about the fact that we will get a lot more data and a lot more information in June. That's a certainty. I think there was also a very broad agreement around the fact that we will not change our views on one single data. And what we are seeing in the data at the moment are indicating certain movements, directionally good, but it is not strong enough and durable enough for the moment to give us sufficient confidence. So that was a generally accepted sentiment around the room. And the decision that we made was a unanimous decision, by the way. You are correct that while we continue to look at the three components of the inflation outlook, of the underlying inflation and the strength of monetary policy, there is two components that we are particularly vigilant about, and those two components are the wage evolution as well as the profit evolution. Unit labor cost, unit profit are two items that we will be particularly attentive to and will continue to be attentive to. I mentioned that in the underlying inflation measurements, there is one which is not moving in the same direction as the others. The others are generally declining, and the range between the various instruments is narrowing as well. But there is one that is not declining, and that is domestic inflation. Domestic inflation is largely informed by services, which itself is, for most services, not all, but for most services, labor intensive, and therefore very sensitive to wage evolution. So those are the two components that we will particularly zero in and try to be laser focused on to see whether there is confirmation or not of this beginning of moderation that we are seeing on the wage front and confirmation of what has been observed on the profits as to whether or not profit absorb and act as a buffer for the wage increases. I mean, we will have the Q4 numbers for CPE, for compensation for employee per employee tomorrow. Our assessment for the moment is declining relative to the third quarter. I think it's a conservative assessment given the various other elements that we try to look at. We look at some backward-looking elements, but we also try to be as forward-looking as we can by, really following very carefully all the new agreements that are signed and how terms and conditions will apply going forward.
Thank you. And the next question goes to Aude Kozelek of BFM Business. Aude, please.
Yes, thank you for taking my question, Madame Lagarde. Underlying inflation is one of the three criteria you look at, and the only one that remains above 3%, at least at that current time. It's forecasted at 2.6% for this year. Is it a level at which you are comfortable to cut rates? And second question, a few days ago, Mario Draghi tells in a speech in Washington that a Eurozone needs low capital cost to finance huge investments. Do you agree with that? And what do you think about the fact that these investments in transitions may be delayed because of high rates?
Thank you for your question. On, I wouldn't say that underlying inflation is the only figure that is above 2%. And, we try to look at the inflation outlook, which includes, of course, the headline inflation, which is the one that, under our strategy review, we have agreed is the compass that we're using. We're also looking, you rightly say, at the inflation without energy and food, otherwise called core inflation. But we don't only look at core. We look at other measurements of underlying inflation to try to, remove the noise from the signals and try to really measure each and every time what is going to be the best indicator to give us the measurements of what is to come. And but I wish everything was, closer to our target. We're not there yet. We are not there. Even on headline inflation, we are still projecting 2.4, which is a revision from what we had before, but we're still at 2.4 in 24, and we are at 2% in 25. And correct, underlying core inflation, core inflation is at 2.6 in 24, and then moving to 2.1 in 25, and finally reaching 2% in 26. I'm not here saying that we will wait until we are at 2% and that we see 2% to take a decision. This is not what I'm saying here. But in terms of projections, both headline and core, this is what we are seeing. We are all looking forward to the two Italian reports, if I may say, because there will be a report by Enrico Letta on the single market, which, would, if fully implemented, would certainly deliver more growth than we have at the moment. And we're very much looking forward to the report of President Draghi on the competitiveness of Europe, which is obviously a major topic going forward. Now, I'm sure he will be making recommendations, and I will wait until we have the report to react to his proposals. But, we have a mandate, we have a mission. We are determined to reach our 2% inflation target in the medium term, and we will be riveted to that.
Thank you, Madame Lagarde. And the next question goes to Balazs Koranyi of Reuters. Balazs, please.
Let me have a sip of water first.
Good afternoon, President. Since our last meeting here, market expectations have gone through a serious revision. There's been a big repricing. How well is the current market pricing aligning with your own views? Are you happy with what's been happening in the market? Is this a better reflection of where you think policy might be going? The other question is about the framework review. Could you tell us where that is standing now? Where is it going? What's the next step in terms of timeline? And is the minimum reserve ratio part of that discussion?
Thank you much for the two questions. I've tried in the past to refrain from passing judgment and commenting specifically on market expectations. I just note that it seems to be converging better, but that's, everyone has to do their job. They do their job, we do our job. We look at the three elements, we look at our projections, we try to anticipate the impact of our monetary policy, and that's how we make decisions, not by being determined by what markets considered. So in terms of the operational framework, we have had a discussion, short of course, because the main agenda yesterday and today was monetary policy, but we had a discussion yesterday morning on the operational framework to narrow areas of discussions and arrive at a platform that hopefully will be a consensus between the governors. My strong expectation is that it will be completed on the occasion of our meeting on March the 13th, and it will then be released, published, explained. I know that our communication department has some ideas as to how to best do it, because it is, I can assure you, a highly technical matter. Some of you are fully versed in the sophistication and the delicacies of operational framework, but it warrants a good review, good explanation. So I hope that March the 13th will be the date when we go out with the operational framework. That will be part of what is being announced.
Thank you, Madame Lagarde. And the next question is for Martin Arnold of the Financial Times. Martin, please.
Hello, I have two questions, Madame Lagarde. The first one is about the pace at which you're going to be normalizing policy once you do start cutting rates. Some of your colleagues on the Governing Council have said they think that it'll be a gradual pace, and there's a benefits to doing that. What do you think gradual means in that context? Do you agree with that? The second one is a bit different. There have been various proposals put forward to utilize the frozen assets of the Russian central bank to fund in some way the Ukrainian government and their defense against the Russian aggression. What do you think about that?
Thank you for your two questions. On your first question, I would use the analogy of seasons and episodes. We are still in the holding season. We will move to the restrictiveness season. That will take a while. And once that season is over, we will move into a normalization season. But, if that's the definition of gradual, so be it. But I would not commit to any kind of pace, rhythm, magnitude, because we will continue to be data dependent. We will continue to observe, how the economy evolves, how the labor market moves, how wages moderate, impact of tightening on the financing of the economy. And all these factors will be taken into account to determine future moves. On your second question, it's a matter which is under discussion at the European Commission level. It's a matter which is highly debated within the G7, which is a complicated issue which has legal ramification. And while there is no doubt in anybody's mind, I think, that Ukraine will need significant financing for its completely legitimate reparation program as a result of this aggressive and unjustified war by Russia against Ukraine. The financing, the sources of financing, the terms under which it is deployed by those who will support Ukraine need to be agreed and need to respect the international legal environment in which we operate and be particularly attentive to the international monetary order and the rule of law which has been enforced for decades. There are interesting propositions that are being reviewed concerning the interests generated by the proceeds, such interests belonging actually to Euroclear, which could possibly prosper, but that's clearly work in progress on which we have no final say. It will be for the leaders to decide what happens.
Thank you. Turning now to the online participants, I'd like to give the floor to Fabrizio Goria of La Stampa. Fabrizio, please.
Thank you, Wolfgang, and thank you, President Lagarde, for taking my question. There are two questions, actually. So the first one is, do you see any possibility that the Federal Reserve decisions could affect the ECB moves? And the second one is about the commercial real estate market. Do you see any vulnerabilities in the European CRA market, considering the stress that we're seeing in the United States? Thank you.
Thank you very much for your question. On the mandate that we have, the mission that we have, the ECB acts independently, and we will do what we have to do when we have to do it. Obviously, we are mindful of the international environment in which we operate, but if the conditions are satisfied, if our diagnosis is that we have been restrictive for long enough to be sufficiently confident that we will reach our 2% targets, we will make our decision. I know there is writings here and there and views about the order and the sequence and reference to previous episodes, but I really think that we have to act in accordance with our mandate. The second question, if I may, dear Vice President, I will pass it on to you. Not that I don't want to answer, but you're far more qualified than me.
Well, good afternoon. Commercial real estate, as you know perfectly, is something that we have reiterated as one of the main risks for financial stability in the euro area. We have seen an important reduction in the volumes of transactions and the transactions in commercial real estate, even before starting the tightening of monetary policy. And we have seen as well, a decline in prices. But what I can say with respect to commercial real estate that I think that is relevant is first that the exposure of the European banks to commercial real estate is quite limited. If you look at the figures, commercial real estate credit amounts something close to 5% of the total assets of the European banks. But the problem is not the average. And the problem, and this happens quite often in economics, is the disparity around the average. And here, there are some, some banks that have, a higher exposure and a higher concentration in their portfolios, in their balance sheets to commercial property, to commercial real estate. And this is something that, well, we have been monitoring very closely. We have not seen so far any sort of, let's say, widespread contagion because of the evolution of commercial real estate. We have indicated several times that the exposure of the non-banks is much bigger, is larger than the exposure of the banks. So I repeat again, this is something that we have been looking at very carefully, and is one of the main risks for financial stability at present.
Thank you very much, Vice President and President. The next question goes to Santi Pinol of Market News International. Santi, please.
Thanks. Good afternoon, President Lagarde.
Good afternoon.
My question is, what would be the ECB approach if we see that the inflation remains sticky around this 2.5 area in the following months? It would be like any changes? In other words, how much growth are you willing to sacrifice for a small deviation? Another question, it's unit costs are partly being absorbed by profits. Is that your view that this will continue in the future? And do you think it will be enough to offset the inflationary impact of wages increases? Thank you.
Well, thank you for your two questions. It's not a question of sacrificing growth. And I would just remind you that in our projection, while aiming at reaching our target timely and in a sustainable manner, as our projection indicate, we also project recovery during the second half of 2023 and more importantly 24, and more importantly in 25 and 26. Our projection is 1.5% in 5 and 1.6% in 26. So what we are really seeing is a slight delay of a process that we had anticipated. And we stick to our projection. Maybe you will have observed that recently our errors in our projections have reduced significantly, and they certainly make us feel more confident, not sufficiently confident yet, but more confident that we will reach the target. Your second question was about the unit labor cost, and you suggested that unit profit cost would absorb, or was absorbing, I don't know exactly how you put it, but you assumed that it was absorbing all the labor cost. This is not quite the case yet, and we have seen some encouraging numbers in the late part of 23 and earlier part of 24. This is really one of the hypotheses that we made for our projection, and our projections are predicated on that precisely. We want to see that movement confirmed, both moderation of wages as we anticipate, but also the reduction or the squeezing, if you will, of profit margins, so that the unit profit cost absorbs part of the unit labor cost. Thank you.
Thank you, Madame Lagarde. And the next question goes to Andres Stumpf of Expansion. Andres, please.
Thank you. I have two questions, if I may. Even if the decision was unanimous, did anyone at the Governing Council suggested or even suggested that cutting rates today? And the second question, is there a huge difference between cutting rates in April or doing so in June? I mean in both in terms of economic pain, but also on the amount of that data you will have for that decision. Is there really a difference? Thank you.
But thank you. Those are really two good questions. So first of all, we have not discussed rate cuts for this meeting. Not, full stop. What we have done is that we have just begun discussing the dialing back of our restrictive stance. But of course, we need a lot more information coming in the next few months to be sufficiently confident. And your second question related to the degree of information. Well, when you look at what will be published, what data we will have, both in terms of activity, in terms of wages, in terms of profit, we will have a little in April, a little. And we will have a lot more for our June meeting.
Thank you.
And it matters because we are data dependent, and we are adamant that we will be data dependent.
Turning back to online participants, I'd like to give the floor to Tom Fairless of the Wall Street Journal. Tom, please.
Good afternoon, President Lagarde.
Good afternoon. No, good morning.
Good morning. I had two questions on the sort of a US angle. Firstly, investors are betting that the Fed and ECB will both start cutting around June and at a similar pace. And given the different economic landscape on both sides of the Atlantic, do you think that's reasonable that they should be expecting that, with inflation and growth lower in the Eurozone? And secondly, the language that you've used today is similar to what we heard from Fed Chair Jay Powell yesterday, in terms of there being no rush to cut rates. And notwithstanding what you said about your ability to act independently, does it broadly make sense for major central banks to lower interest rates at the same time? Thank you.
Well, thank you so much for your question, but in a way, I think I addressed it earlier on when I explained that the ECB is an independent central bank and will act independently. So We will decide on the basis of the 3 criteria that I have mentioned earlier, on the basis of the measurements that we have, the projections that we have, the additional data that we need. We will determine what action we need to take. And that will be done independently from what my colleague from the Fed decides to do. As to whether or not investors are reasonable or not for me to say. What I hope we can do ourselves is be attentive, monitor carefully. Once the data confirm that we are sufficiently confident to reach our 2% target in the medium term and make sure that it will be sustainable, we will act. That's really what I can tell you. By the way, I didn't say that there was no rush. Remember? I said that we did not discuss cuts for this meeting, but we are just beginning to discuss the dialing back of our restrictive stance, provided that we have enough and certainly more information to be sufficiently confident.
Thank you, Madame Lagarde. And another question for online participants from Eric Albert of Le Monde. Eric, please.
Thank you very much for taking my question. I just wanted to come back to what you mentioned at the beginning, the loss of competitiveness of Europe. How permanent do you think it is? How worried should Europe be about that? And then coming back on wages, can you explain a little bit on your thought about it? I mean, you said you don't have enough data for now, but I mean, what kind of data do you need to see to be confident enough? What kind of level do you want to see? And isn't some kind of catch-up of purchasing power needed actually for the European economy?
So thank you very much for your 2 questions. On the first one, I think that we will learn a lot more on competitiveness and how dramatic or not dramatic it is when we read the report by President Draghi. But you can observe that Europe has lost competitiveness in a durable manner for the last couple of decades, and that was accentuated certainly during the financial crisis. So it's one of the reasons why the Governing Council was of unanimous and very strong support for capital market union to be rolled out, obstacles to be removed, supervision to be strengthened, and capital to be kept and made to work at home in Europe rather than elsewhere. It's not the reason, the response, but it's certainly one of the response which matters to us because it is also conducive to transmission of monetary policy in a slightly different way. Your second question, look, when we look at the underlying inflation and the measurement of underlying inflation, there is one obvious outlier in the measurements, and that is domestic inflation, and that is services. So you have to get under the skin of that and determine what is behind it and what drives it up. Clearly, it is wages. And because of this determination to avoid what I've called the tit for tat on previous occasions, we are also very attentive to profits. So it's a combination of the 2. I'm not suggesting that wages should decline or that wage growth should be dampened. This is not what I'm saying. I'm saying that it's a major component of services and domestic inflations. Services is moving just a tiny bit. It was at 4% for the last 3 months. It's moved to 3.9%. Domestic inflation is slightly up. So we have to be specifically attentive to wages. And as many of you know, and as I'm sure you know, a lot of the indicators that we have, a lot of the data that we receive are a bit outdated. We will get the Q4 number tomorrow, which is more than 2 months after the end of the quarter. So we have to look at other indicators as well. We have our wage tracker, which sticks to all the agreements that are negotiated and signed. there is about a third of the employees that are covered by that wage tracker, of which the contract will stop being covered by an agreement as of now or at the latest in March. So we need to have that as well. We look at Indeed, as everybody does as well. And all these elements are showing us that there is an element of moderation. So growth is moderating. It's not going up as much as it did in late 22 and in the course of 23. It's moderate, the growth of it is moderating. So that's what we will be looking at very, very carefully. The fourth element that we also pay attention to is the corporate telephone survey, or the SMA as well, to hear from the corporate employers what is the labor shortage, how much hoarding do they have, to try to anticipate in a still tight labor market where wages are going to go.
Thank you, Madame Lagarde. And the next question goes to Minami Takeru of Nikkei. Minami, please.
Good afternoon, President Lagarde, and thank you so much for taking my question. So let me ask one question for better understanding. This is about wage growth and inflation. I think that even if wages continue to increase, the declining trend in underlying inflation may continue. It's just a possibility, but in this case, which one do you consider more important to decide to cut interest rates? The declining inflation trend or wage growth rate? Thank you so much.
Thank you so much for your question, but we will be looking at all of that, because we continue to look at the three key components: the inflation outlook, and that, you know, tells us what we should expect on the basis of the projections that are prepared by staff. And that indicates clearly that we are in this disinflationary process, that inflation is declining. But we also look at the underlying inflation and what feeds some of these underlying inflation, including in particular wages. So we also look at that because we want to be stable on three accounts: inflation outlook, underlying inflation, strength of transmission. On the latter, I think strength of transmission, we're seeing a good and solid transmission to the financing sector, and then further down the road to the economy. Thank you.
Thank you. And the last question goes to Jean-Philippe Lacour of AFP, Agence France Presse. Jean-Philippe, please. You have to unmute. We do not hear you.
We do not see you either.
We do not hear you, Jean-Philippe. I'm very sorry. I can see you, but nobody hears you.
You can see him not happy with his computer. That's obviously the case.
Okay, well, it will be next time, Jean-Philippe. So we come to the end of our press conference. Thank you very much for following. The next press conference will be on the 11th of April. Until then, all the best. Thank you.
It's Bloomberg's Open. I'm Manish Cranny, in for Jonathan Farrow. You've just heard from the President, Christine Lagarde. Data. More on that in just a moment. I want to set the stage for you on the equity front. This is what we've got for you. A nice, strong bid to equity markets this morning. It's day two of Jay Powell's testimony. The ECB leaves rates on hold. Powell did not embolden the no camp, less than 3 cuts narrative. The commercial real estate market is manageable in terms of leading stocks this morning. Again, that cap fits on NVIDIA, bolstering the technology bid, up nearly 1%, 18,185. Yeah, there are two directors in the NVIDIA camp who are selling stock. They've been on the board since 1983. NVIDIA is bid, stocks are strong. Let me just show you the reflection of what came from the ECB. This is where, in the very first instance, traders began to reprice 100 basis points of cuts this year. The growth outlook for this year was cut by the ECB. They talked about inflation coming to 2% in 2025, a dovish hue. Christine Lagarde came out and subtly but deftly unwound those bets. She talked about a gradual pace. She talked about a situation of where we don't have enough data. We won't have enough data in terms of movement. We will move before the core hits 2%. She needs more data to be more confident on moving. That sounds more like June. And in terms of a commitment to the pace, and this is something we must all get a hold of globally. There's a holding season that moves to restrictive, then you move to normalization. She will not commit to a pace, a rhythm, or a magnitude of cuts. And that is a global caveat we all need to grasp, from the Fed to the ECB to the Bank of Japan. Let me show you the immediate ramifications across the bond markets as well. In the very first instance, we saw a more significant drop in yield across the Bund, the Bobble, and the Schatz, 2s, 5s, and 10s. That has been unwound now as she talked about the concern about wages remaining hot. And that is 4.5% on wages, sequential core at 4.3%. The warnings were there in terms of the ability to move. They are not there yet. Christine Lagarde weighed in on the ECB's decision.
There are signs that growth in wages is starting to moderate. In addition, profits are absorbing part of the rising labor costs, which reduces the inflationary effects.
Joining me now to discuss is Invesco's Alessio De Longis and Winnie Sizer from Credit Insights. Winnie, to you first of all, this is a deft president. The market got all doved up on the headlines, and she came out basically, I think, giving the narrative that all central banks want to communicate, which is we're not there yet, we don't have the data yet. And if anything, this was a very clear narrative to the markets that central banks are so fearful of moving early, isn't it?
I think so, and I do think that Lagarde benefits from the hindsight of the December Fed press conference, where Powell came out much more dovish than we had anticipated. The market really took that, ran with it. Financial conditions eased considerably, and central banks have not seen the progress on the data that they want to see to start to really talk about cuts being on the table, even though the market really continues to presume that they are.
Indeed, and in terms of that pro-risk narrative, and this is the point, Alessio. Again, all of these markets are in a pro-risk soft landing mode, aren't they? But the more that we hear from central banks, the more hesitation there is imbued in risk.
Yeah, correct. The first push towards risk was really driven by this expectation there would be meaningful and aggressive cuts. As that view didn't materialize, as you alluded to, didn't materialize really anywhere yet, markets are still showing that resilience because ultimately they found a comfort zone with growth that is stable and improving on a go-forward basis. We saw it also in the projections for the ECB. While inflation, yes, it's not falling as rapidly as hoped, but it is at 2% on a projected basis. Basically, inflation is no longer a risk factor for the market. We talked about that Goldilocks scenario. That continues. No news is good news.
A very quick response from both of you. I want to move the agenda along to the US and to Powell, but very quickly, I had Allianz with me this morning, one of their chief economists, and basically said the biggest risk for the ECB is that the Fed does not move. Tail risk or real risk? Alessio?
The Fed not moving, I would call it still a tail risk. I more second your view from earlier, where I believe this cutting cycle for the major central banks is going to come somewhat synchronized, as you alluded to earlier. And that's also explaining why FX volatility, currency volatility is extremely reduced, with the exception of the Japanese yen. The Bank of Japan is the only central bank that is moving the other way towards rising interest rates. That could be the main story for the second half of the year.
It could indeed, and then we can debate whether that's one and done and what that does. Winnie, before we shift to the Fed, how important is it that the Fed goes before the ECB has the capacity to go? Because it's a danger, according to Allianz.
Yeah, so we have expected that the Fed is going to go first, just given the progress of inflation in the US versus the Eurozone until recently. Now, I think it's a little bit more of an even split. We do expect that the Fed should go as soon as May and the ECB perhaps in June. But I don't know that necessarily we need to see the Fed cut in May in order to see the ECB cut in June.
Okay, the sequencing, let's see whether it is a concertina as always, or as it historically been. Okay, stay with me, team. We've got a little bit more fresh data out of the US today. Investors are gearing up for the second day of Fed Chair Powell's testimony and the US payrolls report. We're counting down to that. Mike McKee is with me. I don't know whether it's too early for the whisper number. Mike, good morning.
Well, the whisper number for tomorrow is pretty much what we're getting for the consensus number. I'll get to that in just a second. Here's the data from today. If you're looking for something to push the Fed one way or another, you're not getting it, because basically what we are getting is data that doesn't show much change in the state of the U.S. economy. Jobless claims, same as last week. Continuing claims go up just a little bit, but that's because the previous week was revised lower. January trade, the one outlier, a little bit weaker trade deficit, and that does subtract a little bit from first quarter growth. Productivity unchanged in its revision. So market looking at these numbers, I mean, we're pretty much status quo in the economy. So what does Jay Powell say today? Well, on rates, it's going to be the same story, you know, maybe sometime this year, but not yet. Bank regulations were big in the House yesterday. They'll probably be even bigger in the Senate today. Elizabeth Warren, Sherrod Brown, he'll say they're still reviewing it. Yesterday, he said, do expect changes. Balance sheet, he said yesterday, not an issue. QT continues. The one thing that didn't really get asked yesterday, might come up today, is on the U.S. debt. He said on 60 Minutes that it's unsustainable, but he'll take the usual Fed attitude of, you guys fix it, we don't get involved in this. You mentioned the jobs numbers, so let's see where we are now. February payrolls expected to come in at 200,000, the whisper number 203,000. So Wall Street leaning pretty much with the consensus. Private payrolls up 160,000. That compares to the 140,000 private payrolls we got yesterday at ADP. No change in unemployment, and we do expect, or at least economists do, a drop in average hourly earnings on a month-over-month basis that pushes the year-over-year down as well. That would be welcome news to the Fed, which thinks that year over year we should be running about 3 to 3.5% for sustainable inflation. But that's the only kind of outlier in the forecast for tomorrow. Although, man, I have to say, 200,000 seems like a big drop from 353,000. But a couple of months ago, we were talking about 180,000 as a big number. So we're still looking at a very strong labor market.
Yeah, unemployment sub 4% and wages are strong. Mike McKee, thank you very much. My guests this morning are Alessio De Longis and Winnie Caesar on the markets. Alessio, to you first of all. I mean, you know, we start another day. It's been almost, let me just give you the fact. I mean, I was quite shocked by this. The longest streak without a 2% drop. I mean, this market is bolstered by investment liquidity and topped up by retail flow. Yet you have a concern that that there is going to be a moment of where we return to the mean. And you make this point. How soon will this market take a breath?
What we refer to a bit of a return to the mean is particularly to the biggest spread, the biggest anomaly that we have seen from a cyclical perspective, which is this outsized outperformance of quality mega cap tech relative to sectors and styles in the equity market that at this junction with improving growth and stable inflation should have outperformed much better, such as small caps, mid caps, value-oriented sectors. These cyclical sectors have lagged the cyclical move. That's the mean reversion that we are more concerned, actually not concerned, actually positioned for. But in this environment, the overall equity market and risk assets in general, including credit, we believe until something breaks, and it doesn't look imminent. Investors, in our opinion, are still compensated to take risk, whether it's credit risk or equity risk. And it's only in the equity market that we will suggest a rotation in favor of cyclicals, expecting some mean reversion in the outperformance of mega cap tech.
So Winnie, it's the perfect world, isn't it? Nothing's breaking. Alessio's chilled. He wants to take risk. We're all bulled up pretty much every day. I don't know how much more bullish we can all become, but is there enough in credit for you? Is there enough return, briefly, in credit for you at the moment?
I would say on an all-in yield and total return basis, absolutely. Yields are still quite elevated, really globally across credit. It's that spread dynamic. How much are you getting paid to actually take credit risk that people are a little bit more wary of? And we've seen an interesting shift this year where triple Cs have been underperforming. Spreads are a bit wider there year to date, which is a reversal from what we saw in 2023.
Okay. Thank you very much, Alessio and Winnie. On the markets coming up, countdown to State of the Union with the details on what to expect right here on Bloomberg. Good morning.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists, because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
This is probably the most important speech he's going to give the American people. President Biden right now is historically behind every single president except President Carter on 5 to 6 of the most critical metrics that we've relied on historically to gauge how strong a president's position is going into re-election.
President Biden prepares for a consequential State of the Union address. That's tonight, 9 p.m. Eastern. This comes as Biden faces mounting pressure on an array of political issues, including immigration and the economy, as well as concerns over his age. Anne-Marie Hordern is in the Capitol for us, tracking the State of the Union. Anne-Marie, good to have you with me. We've talked about the significance of this speech. I really want to drill into the content in terms of the key message. Good morning.
Good morning, Manus. Yeah, the significance is not lost on anyone. A lot of people in Washington are calling this, Greg Valliere this morning in his note, Biden's most important speech of his presidency, given the fact that it's not just a report to Congress and the American people about the State of the Union, but the fact of the matter is that what he is going to be pitching if he was to be reelected in the next 4 years. So when you get into some of the substance, what matters to the markets, you know, we talked to Tobin Marcus earlier, and he talked about the fact that talk isn't just cheap. A lot of the stuff has to do with policy. When you look at tax policy, that's going to be something that's key to this election, because the Trump-era tax cuts expire at the end of 2025. And both former President Donald Trump and current President Joe Biden have been talking about taxes. Donald Trump wants to talk about lowering taxes. The current president wants to talk about raising taxes on corporations, raising the rate of a corporation that has buybacks, and also a wealth tax, a billionaire's tax, something that isn't likely to get through, but something that certainly is a rallying cry for progressives. One thing we can take away, whether or not it is Biden or Trump in the White House next year, some of Trump-era tax cuts will live on, because President Biden has also promised to not raise taxes on those making less than $400,000 a year.
Briefly, Anne-Marie, how will the border play in this? I heard you do an interview earlier on with Congresswoman. Will Biden pull the ripcord on an executive order on the border? Briefly, very briefly.
He's been weighing that decision. I'm not sure if we're going to get him to come out and say that today. What he is going to likely do is what he did when he visited the southern border and invite former President Donald Trump to tell Republicans in Congress to sign up to that bipartisan agreement he struck with senators.
Anne-Marie Hordern, thank you very much for being with us. We look forward to full coverage on State of the Union, the address at 8:30 p.m. That is tonight on Bloomberg. Let's get you some sector price action. These chips are flying higher. Tech is hot. Abigail Doolittle is with me to go under the hood.
Yeah, in fact, all sectors are hot, man. As we're looking at all 11 S&P 500 sectors in the green, the best materials, interestingly enough, so some nice breadth from the tech rally as well. Materials up 1.4%. Then to your point, communication services and technology, both up about 1%. The worst sector, healthcare, up nearly 0.2%. So again, bullish sector composition. Let's take a look at the banks, because of course we've had lots of volatility recently with the regional banks, in particular New York Community Bank. That stock is sharply higher. Fitch has affirmed its BB+ rating on the company's capital infusion plans. They also finally have given an update in deposits, probably better than feared, coming in at about $77 billion, just down 5% from the last read at $81 billion. They cut the dividend. Investors seem to think that maybe at least right now it is shored up, and you can see that the overall sector, Manus, is doing well in sympathy.
Yeah, well, that's what you call whiplash, isn't it, Abby? I mean, a turnaround of over 50%. Yes, Abigail Doolittle tracking the big stories for you. Your trading diary, this is what you need to watch out for the rest of the week, and there's not much of it left. Today, the Fed Chair, Jay Powell, testifies before the Senate. Cleveland Fed President Loretta Masters speaking at 11:30 a.m. On the earnings front, we're coming near the end of this quarterly report. Gap and Costco come in after the closing bell, and President Biden delivers that all-important State of the Union address. That is at 9 p.m. Eastern Time. And of course, we're counting down to payrolls number. The whisper number is just over 200,000 for tomorrow. That hits the tape at 8:30 a.m. Equities are bid as we wait for Jay Powell's day 2 of his communication to the market. The Nasdaq is flying higher. I can tell you this morning, it's a lot of the chip stocks that are on the move with real sentiment trading higher there. FTSE 100 up 1/3 of 1%, and you also have Deutsche Börse up 0.6% as we've just had the ECB leaving rates unchanged, and the president to the ECB, Christine Lagarde, pushing back hard and resolute that they don't have the data to cut, wages are too hot, and that she will not commit to a cadence and a timing and a rhythm of rate cuts when they come. You need to think about that from a global perspective, right here on Countdown to the Open. Good morning from New York.
adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Your fixed income fix. Watch Bloomberg Real Yield at its new time Friday at 12 p.m. Eastern right here on Bloomberg. Context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. You're listening to Bloomberg Intelligence. Alex Steele, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. Also streaming on YouTube as well. So just go to YouTube and search Bloomberg Podcast. Today, day 2 of testimony from Fed Chairman Jerome Powell. Before today, the U.S. Senate Banking Committee. We'll bring you the Q&A to that. It's probably starting in about 15 minutes time or so. And we'll lead up to that with Steve Matthews, Bloomberg Federal Reserve reporter. Yes, we have a Federal Reserve reporter at Bloomberg News. He's going to give us a little preview of what we might hear from Fed Chairman Jay Powell. So that's all coming up. Let's kick things off on this Thursday morning with a Bloomberg Business Flash. John Tucker.
All right, major stock averages pushing higher, hovering around records. All 11 major industry groups in the S&P 500, they're in the green right now, with materials and technology in the lead. On communication services, we'll say. Best performing stock right now in the S&P 500, Kroger and Freeport-McMoran. Nori's going to take a deeper dive into some of these in a few minutes. Hewlett-Packard Enterprise, the biggest laggard. And as we wait for day 2 of a testimony from the Fed Chair, Jerome Powell, this time the Senate Banking Committee, Christina Campany at Invesco says we're going to get more clarity from the Fed when they get more clarity.
They just seem to have this confidence issue, and it's not that we need better data, it's just we need more of it to have more confidence. So we still are in the camp that they ease 2 to 3 times this year. And I think beyond that, so much will depend on what the election outcome is and where we are kind of growth-wise.
And investors waiting for the jobs report. Non-farm payrolls expected to show the economy added 200,000 positions. That's out at 8:30 tomorrow morning. Ahead of that, we got this morning the weekly jobless claims holding at historic lows. S&P 500 right now 34 points higher. That is up just about 0.7%. 5139 on the index. The Dow Jones Industrial Average up 169 points. NASDAQ 100, that's up 153 points right now. That's a rise of 0.9%. Two-year yield, 1 basis point lower at 453. The 10 unchanged at 410. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube as well, so just search Bloomberg Podcast, and that's where you'll find us. You can also do it on the whole Bloomberg app thing in your smart card, right in your dashboard. Tom Keen's all fired up about that. Alex, another day of gains here in the stock market this morning.
Yeah, but I think at least this time I can point to something that makes a little bit of sense, and that's the ECB. I know that might bore our U.S. audiences, but let me tell you why it's important, is because it's still a central bank cutting rate environment. Yep. They clearly set the table for cuts starting in June, and then the question is, like, how many? Markets now pricing in 100 basis points. Bloomberg Economics thinks it could be more. So we're in that cycle. It's affirmation, so lower yields by risk.
Yep, looking at the stocks index for the European stocks up 1.1%. The FTSE's up 0.4% here. And the S&P 500 here in the U.S. is up 0.7%, as John was just reporting. So some pretty decent gains across the board. Coming up in just moments, we will bring you the Q&A session for Fed Chairman Jay Powell testifying in Washington in front of the Senate Banking Committee. So we'll bring you the Q&A there, maybe some fireworks. We'll see. Right now, let's see what's happening underneath the hood with that stock market. We can do that with Norm Melinda. She covers the markets for Bloomberg News. Norm, what do you have for us?
Well, we can't start the day without talking about New York Community Bank Corp. This company has been in focus for about the past 2 days, and obviously before that. But the news of the day coming out yesterday was that the company received an equity infusion of more than $1 billion. And this is coming from three different investors, including U.S. Secretary Steven Mnuchin, and the others being Hudson Bay Capital and Reverence Capital Partners. But the shares are surging this morning, up as much as 16%, now trading about 9% higher. But we also had some news coming out that it was just affirmed at BB plus by Fitch Ratings on that capital infusion. And Mnuchin actually spoke on CNBC earlier saying that he views NYCB as a 3 to 5 year transaction. And the biggest problem in that portfolio is the New York office loans, but he doesn't see the New York office loan portfolio improving.
Yeah, but he also made a nice, juicy paper profit over the last 12 hours, basically.
Wasn't the investment at $2 a share?
Something like that, yeah, and you could buy warrants for that, et cetera. Also, what was interesting, though, is on their conference call, they did say that core deposits shrunk just over $12 billion. That's nearly half of its total uninsured deposits. I'm trying to understand if that's good or bad. Like, losing deposits never is good, but, like, is this number better than we thought? Like, does it prove that there is stickier deposits versus, like, an SVB? I don't know. I'm still trying to get a read on that one.
Right, and I think it was trading a bit lower on that in the pre-market, and we're now seeing it flip a bit. But it also did say that it's cutting its dividend to 1 cent per share from 5 cents.
Stock's up 10% here, $3.80. We had Chris Whalen on surveillance just an hour ago, and he's kind of one of our go-to voices on the U.S. banking system, and he feels that $1 billion will not be enough, that they will need more capital. So we'll see how that plays out. But again, nice response in the market place today with the stock up 10%.
Here's not a really good response. Victoria's Secret.
Oh, yeah.
Shocker.
Quite
you
the
don't
plunge.
Buy uncomfortable underwear.
Right, what a shocker.
Yeah. John Tucker, don't press that on button. Don't press it. What do you have to say?
I was just going to say, I wouldn't know.
Well, those shares are sinking as much as 28%. Now, this is the worst day ever for the company, and it's trading at its lowest since November. Its full-year sales guidance fell short of analyst expectations. It said that it expects net sales of $6 billion this year, which is weaker than last year. And we had a bunch of analysts coming in downgrading, JP Morgan being one of them, downgrading it to underweight from neutral. It said that the company's pledges to improve sales did not actually come to fruition. So pretty disappointing here, but the company is touting its international sales, saying that it grew about 24% last quarter. But apparently that segment only makes up 10% of the company, so I don't know how much of a boast that is.
Well, I mean, we used to have a big store across the street.
Right.
And that was one of the victims of the earliest days of the pandemic. I think that they shut that down. So,
and I think it's going to be Donna Karan now. Did you see the new ad signs?
See, I'm not sure if that's a coming soon store or just a billboard for Donna Karan.
Oh, that's interesting. Okay.
Yes, I'm not sure.
My memory of it was there was a riot at one point during the Black Lives Matter before that, and my memory was going across, all the windows were broken, and there were underwear and bras all
everywhere?
over Lexington Avenue.
Oh, wow. Scattered.
Yeah.
Scattered.
Did you get pictures of that?
There must be somewhere.
Yeah.
I mean, I was reporting live out there on,
that's
the aftermath.
All right, Nora, thank you so much for joining us. Norma Linda, she covers all the equity markets for Bloomberg, and we appreciate getting some thoughts there. Again, we were waiting on Q&A from Fed Chairman Jay Powell. Let's get a little preview here. Steve Matthews, Bloomberg Federal Reserve reporter. Steve, what did you hear yesterday? What do you expect to hear today?
Well, what's the Yogi Berra quote? It's deja vu all over again. We do it all for 3 hours today. We're going to get the same text today from Chair Powell. And, yesterday, a lot of the questions were on financial services, capital requirements, Basel III. And it'll be interesting, to see whether we get a little bit more on monetary policy today. Sometimes the senators can be a little bit more thoughtful than the House members. Hopefully, I'm not insulting anyone. And we also get an appearance from Senator Warren, Elizabeth Warren, who's sometimes been combative. I mean, she's the one who referred to Chair Powell as a dangerous man a few years ago and opposed his confirmation. So that interchange can always be interesting.
So, yes, for sure. I wonder if everything got a whole lot more interesting over the last 12 hours because we had NYCB and a basic, in essence, an investor bailout led by Steve Mnuchin. What do you think the questions are going to be around that? Because this is a terrible thing for shareholders and the small portion of those guys that still own it.
Yeah, I mean, the questions around that are that, what was the role of regulators? Did the regulators require additional capital? Did they arrange this deal? What kind of role, are they worried about, additional failures or some kind of financial stability issue that's broader than this? Obviously, New York Community Bank has its own issues with what's happening with rents in New York City and the controls there. So it really was not raised yesterday. It's a hot issue in the markets today. It'll be interesting to see if that's raised today. It should be. So,
Steve, I'm seeing some research from Bloomberg Economics, kind of a reaction to yesterday, saying, hey, maybe, the testimony yesterday at least, was less hawkish than it could have been. Is that your read, or do you think they were just being pretty consistent?
Yeah, I think that's right. I mean, generally speaking, it was down the middle in the sense that Powell took the message from the committee in January at the last meeting and said, basically repeated a lot of the forward guidance and said, we're not going to move soon, but we still expect to move. He used the words at some point this year, and some people view that wording as being a little bit on the dovish side because, some of the Fed watchers and the Fed presidents have said we're going to move later this year. Later this year sounds like, man, maybe that's the second half or something. I mean, it's in a while. At some point this year is kind of open-ended. That could mean basically any time. And there was another point in which he was asked about, how much more evidence do you need to see before cutting rates? And he said, well, we need to see a bit more evidence. That didn't sound like a lot, and we don't need to see different evidence. We just need to see some more good inflation reports. So it did lean slightly dovish.
So if we go to there's no need to hike anymore versus there's no need to cut, where are we in the latter? Because we're going to get jobs tomorrow. The JOLTS number still came in really strong. Dan Curtis, who is our amazing chart guy over in London, he runs the whole team. He pointed out to me that small businesses in the JOLTS data are the ones that have job openings. This is good stuff. When do we go to there's no need to cut now?
Yeah, I mean, tomorrow's report on jobs is going to be really critical. In the JOLTS report, we have seen quits kind of trend down. I mean, fewer people are quitting their jobs, for example, and there's some signs of moderation overall in the job market, and that's what the Fed wants to see. Powell's referred to the market as still being very tight, but has cited some moderation. And, you know, another really critical element before the meeting in 2 weeks is CPI next week. I mean, we've had one bad inflation report, and some people were pointing this as a dovish sign. He didn't mention the bad inflation report in January. I mean, he could have singled that out.
All right, Steve, thanks so much for joining us. Steve Matthews, Federal Reserve reporter, Bloomberg News, joining us via Zoom from Atlanta, Georgia. Right now, let's go down to Washington, D.C. Fed Chairman Jerome Powell testifying before the U.S. Senate Banking Committee. Let's go to Washington and listen in.
Workers from losing their jobs rather than...
Yeah, right now speaking is Senator Sherrod Brown.
So we're well aware of that risk, of course, and very conscious of avoiding it. And what we said is if what we expect and what we're seeing is continued strong growth, a strong labor market, and continuing progress in bringing inflation down, if that happens, if the economy evolves over that path, then we do think that the process of carefully removing the restrictive stance of policy can and will begin over the course of this year.
I mean, I know we've had this conversation publicly here or privately also that, you know, working people are hit the hardest with inflation. They're also hit the hardest when companies try to cut costs with layoffs. This town too often seems to forget that maximum employment is part of the Fed's dual mandate. Let me ask you about bank supervision. Senator Scott mentioned that. Last year's bank failures illustrate the need for strong oversight. SVB grew too big, too fast. Fed supervision didn't react decisively enough. The Fed, in response, undertook an assessment of its supervisory process to identify and address gaps related to the speed, the force, the agility, if that's the right word, of its supervision. Explain what concrete steps the Federal Reserve's taken to strengthen supervision in any specific areas where work to make improvements is ongoing.
So this is a very broad area of work. There are, you know, many people in the Federal Reserve System who are involved in supervision, thousands of them, and there's a rule book, and so there's been careful study and thought and a lot of listening to understand how we can meet those goals of being quicker and more effective. Basically, is how I would say it. If you look at Silicon Valley Bank, we weren't quick enough and we weren't effective enough where we were in, and so we're working hard to develop a new rule book and another set of practices, which is still going to be evidence-based and fair, but it's going to involve earlier interventions and more effective ones. And you know, I think this is work that's ongoing and will be for some time.
Thank you. The job of the Fed, of all public officials, is to serve the American people, not their stock portfolios. We've seen abuses in this body. We've seen abuses at the Federal Reserve. I wrote to you last month asking the Fed to identify substantive penalties for board officials who violate the trading rules. Where is that in the process? And I expect these rules in place before the next monetary policy hearing in 6 months. Where is it?
We got our own Inspector General gave us 6 things to work on. I read the list from beginning to end, and the 6th one was what you said, and I just said we're going to do all of these. Let's get going. So we've done 5 of them, and we're working on the 6th.
And it will be finished within 6 months when you're back?
I want to get it right. I certainly hope so, and expect so.
Expect so is a better answer than hope so. One last question. More and more, many companies use algorithms that combine competitors' price information to engage in what they call dynamic pricing or surge pricing. You know that corporate PR teams worked hard on this. Just another way for corporations to make it harder for consumers to seek out lower prices and to pad corporate profits. Are you concerned that the wide adoption of these price gouging strategies, these pricing schemes, if you will contribute to inflation?
I mean, I think it works both ways. Let me say this, you know, we're well aware of this trend and we're monitoring it. Remember that prices go down when there's no one in the store, and they go up when there are a lot of people if you're doing dynamic pricing. Same thing with the ride companies. It works both ways. I don't know that it have implication for, you know, for inflation. It would certainly have implications for consumers who need to be informed.
You think that this kind of surge pricing might lower prices overall?
I mean, that's my understanding is that the idea is that in slow periods, prices actually go down, and in higher period, in busy periods, they go up.
But these are sophisticated economists working for these big companies, and they're not going to do things to lower their profits.
I think the price mechanism is incredibly important in our economy. I think we need to give companies the freedom to do that as long as they're not fixing prices or failing to disclose the nature of the price changes to the public.
I have a few seconds. Research has indicated constrained supply was behind a significant amount of the inflation we've seen over the last few years. If the supply chain, for instance, of autos had been more resilient, or if there had been more housing availability, would that have made your job easier?
Yes, in a word. Yeah, a big part of the inflation was, and we saw it in 2023 when the supply chain problems unwound and when the labor supply shock that we had unwound as well. We saw inflation come down very quickly in the second half of the year. But it's also down to tight monetary policies playing a role as well.
Which leads me to the plea with you to speak out about inflation, about the contribution of corporate profits and greed to inflation. Thank you.
Oh, I know you are done. That's true. Well, I was
Find yourself agreeing with me more and more often? Is that what?
That would be a nightmare, and I'm awake. So what I would say, however, is that the fact of the matter is that so often, if in fact 60%, I actually listened to what you said, which was remarkable. The fact that 60% of Americans today can't afford a $1,000 emergency, I can't imagine how the average millennial affords a down payment for a home.
Right now,
I can't
Senator
imagine
Tim
how
Scott
they
is speaking.
take into consideration when they're looking at a snapshot of their financial future, fixing and repairing or having a plan for obsolescence that happens for every homeowner in the country. I think the issue is far more complicated and would love to delve into that over the next 4 minutes and 18 seconds. But my first question is a combination between the challenges of illegal immigration and crime. It seems like every single week there's another story of another city underwater attempting to feed and house millions of illegal immigrants, and American taxpayers are footing that bill. Like I mentioned in my opening statement, just recently in Denver, we saw city workers having their hours essentially zeroed out so that the city could allocate more resources for the illegal immigrants. In San Francisco, they say that the average cost between San Francisco and Oakland, because of crime, is almost $4 billion. Couple that with in New York, you see Governor Hochul bringing out the National Guard and the state police to help reduce the impact of crime. At the same time, Mayor Adams says he needs more money because the state of affairs from illegal immigrants in the city is devastating the economy, scaring the citizens, and reducing the opportunity for business as usual to return to New York City. So my question is, can you explain how our economy is expected to continue shouldering the burden and the costs because of illegal immigration? And what, if any, information do you have as it relates to the impact of this surge of crime in our major cities on the economic outcomes of those cities? Because I heard the discussion that when you have more folks in the store, you have more shoppers, except for these days, when you have more folks in the store, sometimes they're just there to steal.
So you quoted my statement earlier, and it was an accurate quote, for which I thank you. But I would say right before that, what I said was immigration policy, very important, very much under discussion, and it's none of our business. We don't set immigration policy, and we don't comment on it. So,
but you commented on immigration. So my point, though, is that when you're going to tell a story, please tell the whole story, especially when the nation is frustrated by nearly 10 million folks by the end of this year coming into the country and having the kind of negative impact on prices, on crime, on the challenges that everyday Americans, especially Americans living in the poorest parts of America face on a daily basis.
So, as you accurately quoted, I said over time. So I was referring to the history, which with you agreed. So I was staying as far as I possibly could from the current political context. And, you know, it's really not appropriate for us. We're independent. We like to remain that way. And the way we do that, one of the ways is by staying out of political issues that we really aren't assigned. And so the kinds of issues you're talking about are very, very real. I don't deny that, but they're really not for us.
So the Fed does not consider the impact of 10 million illegal immigrants coming to our country and the costs associated with those illegal immigrants, nor do they consider the impact on states like New York or California or Illinois, where the devastation of crime ravaging the poorest Americans has an impact. We don't take that into consideration.
So we do. And so does the Congressional Budget Office. We do try to estimate population, and we try to estimate the effect of immigration, legal or illegal, on the size of the workforce and on GDP. If you look at the Congressional Budget Office has, as you probably know, a detailed assessment of all the things like that. We don't really have a way, and we do look at the finances in the aggregate of state and local governments. That's in the hiring that they do. So that's something we look at, but we wouldn't do a very specific assessment like that. I mean, CBO would, but we wouldn't do that.
Thank you.
Scott, Senator Menendez of New Jersey is recognized.
Thank you, Mr. Chairman. Before I begin my questions, I want to celebrate that in the past year, we have seen the first Latino Federal Reserve governor and the first ever Latino Federal Reserve Bank president. These are historic milestones that show we are finally making progress, something that I have been at for quite some time, to the leadership of our economic institutions. So I want to applaud that. And Mr. Chairman, I hope that progress can continue and extend to the rest of the Federal Reserve staff.
Thank you.
I agree with my friend, the ranking member, that when you tell a story, you should tell the whole story. Mr. Chairman, are you aware of the Washington Post February 27th article that says the economy is roaring and immigration is a key reason?
I don't recall that, but I would have read it.
Let me read it to you. Immigration has propelled the U.S. job market further than just about anyone expected, helping cement the country's economic rebound from the pandemic as the most robust in the world. It goes on to say, economists and labor experts say the surge in employment was ultimately key to solving unprecedented gaps in the economy that threaten the country's ability to recover from prolonged shutdowns. Would you take issue with those statements?
You know, there are a lot of adjectives and adverbs in there that you wouldn't see in Fed world. But the
take out the adjectives and give me on the substance.
The story is, I think, broadly it is that there was a very significant increase in the size of the workforce last year, and it was happening all during the year, and we were wondering what it was. And the answer was it was really two things. It was labor force participation, but it was also immigration. And if you look at the Congressional Budget Office numbers, it kind of makes sense because there was a lot of growth. Wages were coming down. The economy is bigger. And those are probably in part affected. This is without making any judgments on immigration or immigration policy, but I think that's an economic fact.
I'm not suggesting that. I'm just suggesting the facts are that we had 10 or 11 million jobs that were going unfulfilled in our economy. They lacked the productivity that is necessary for success economically. And as part of that, clearly, immigration helped fuel part of our revival coming out of the pandemic. In fact, those were the people who were the essential workers when the rest of us were staying home. So I agree we need to do what is necessary to have a regularized border, but I also think that just to create the context of immigration as a scourge is absolutely wrong. Let me turn to another question. In my view, the sticky inflation we've been seeing in the housing sector is principally due to the massive nationwide housing shortage. The Fed's monetary policy report attributes the shortage to restrictive zoning, high interest rates, and tighter underwriting by banks. I would also add to that list underfunding of key HUD programs that shore up and expand our supply of affordable housing. If the housing supply shortage continues to grow, are we likely to see continued housing inflation?
Yes, we are.
And housing is already becoming less and less affordable for low and middle income Americans. According to the National Low Income Housing Coalition's 2023 Out of Reach report, a worker earning the minimum wage in New Jersey would have to work 2 full-time jobs to afford a modest one-bedroom rental home at fair market rent. Do you agree that increasingly unaffordable housing is a problem for the economy?
I think there are two things going on. One is a longer-term housing shortage, and the other is the pandemic effects and the associated higher interest rates, which are things that will pass through. When all that passes through and rates are normalized, we'll still have the underlying housing shortage, and it's going to be causing upward pressure on housing prices.
Now, the Monetary Policy Report noted that, quote, home purchases by low-income households have fallen disproportionately more because mortgage lenders impose maximums on the ratio of a borrower's debt service payments to the borrower's income. I'm worried about how this dynamic will interact with the recently proposed capital requirements proposal, which, according to analysis from the Urban Institute, would disproportionately increase the cost of mortgages for Black, Hispanic, and low and income moderate borrowers. Given this, isn't there a risk that if the capital rules implemented without changes, that it could make it even harder for disadvantaged borrowers to attain home ownership?
There is a risk like that, and we're very focused on it.
And hopefully you're working to mitigate it.
Yes.
Thank you. Thank you, Mr. Chairman.
Thanks, Chairman. Senator Rounds from South Dakota.
Thank you, Mr. Chairman. Chairman Powell, welcome back. Look, first of all, I've appreciated the way that you've approached the discussions in front of this committee, and I understand your desire to stay as neutral as possible with regard to the politics involved in an election year. But I do have some questions here, specifically with regard to the Basel III Endgame proposal. An analysis of that proposal found that 97% were either opposing it or expressing substantial concerns. In the hearing last March on the Monetary Policy Report, you stated that the Federal Reserve is a consensus organization, and you said, and I quote, I will do everything I can possibly to bring people together in consensus and have a capital framework that could be broadly supported. My question to that is, do you currently believe that there is a consensus on this capital framework?
I believe that we will have one. I'm fairly confident that we will have such a consensus when we do move forward.
So we could expect that you will probably not call a vote on the proposal until you believe that there is a consensus?
I think that's right. I mean, we're just in the process of digesting the comments and then making the appropriate changes.
Thank you. As you are aware, I've weighed in several times on the concerns that I have with regard to Basel III Endgame, including I'm concerned about the lack of transparency, the negative effects on mortgage lending and home affordability by disincentivizing banks from offering high loan-to-value loans that primarily help first-time home buyers and low to moderate income borrowers. I'm concerned that the proposal will make buying a home harder than it already is for many. And further down the road, I fear that it could disincentivize mortgage lending from the largest banks, particularly with regard to the secondary market and their impact on even smaller banks that do business with them. Would you be willing to withdraw the proposal or re-propose with significant modifications, particularly addressing the concerns that I and others have on this committee, raising specifically with regard to the impact? And I'm thinking of Freddie and Fannie in particular and what the impact might be. What would you see as the process involving those particular issues?
So on those issues, we're well aware of and very focused on those issues. We haven't decided what to do about that yet, but we get it on those issues. In terms of process, we're not at the stage of making that decision. I will say if it turns out to be appropriate when we get to that point for us to repropose parts or all of the thing, then we won't hesitate to do so.
Okay, thank you. Makes me feel a little bit better because I do think there are some very serious problems that would occur if the Basel III Endgame as proposed goes into effect. And I most certainly am hoping that the Federal Reserve will find a consensus on this, and it sounds like that may very well include some significant modifications if it were to be brought at all. Is that a fair statement?
I expect there will be material and broad changes to the proposal before it comes back to the committee for consideration, the board for consideration.
Thank you, sir. Let's just, with regard to the economy today, a limited level of price growth is believed to help facilitate economic expansion, reduce the risk of recession, and help businesses and consumers plan. However, during the Biden administration, we saw inflation climb to 13%, and those prices are now the new norm. I know that you make it a policy not to comment on the administration's fiscal policy, but it is well known that I really do believe that high inflation and high prices have been a direct result of President Biden's policies, failed in many cases, that the Federal Reserve has limited tools to address some of the problems that these policies created. We talk about supply side versus demand side on these costs. What have been some of the unintended consequences from raising the federal funds rate as rapidly as you felt that you had to as the chair and as the committee? What are some of those? I know that we talked a little bit about SVP and the failure there, their inability to look at treasuries and the increasing interest rates and so forth. But can you talk a little bit about some of the things that you've seen that were negative with regard to trying to respond to those high inflation rates?
Yes. So high interest rates are hard for businesses. They're hard for people. They're the thing they're the tool that we have to use to bring inflation down. And our job at this time, when high inflation comes, it is the Fed's job to restore price stability, and that's what we're doing. You point to the losses in banks. That was a very substantial thing, and obviously the supervisors, and that was us, didn't get to that problem. We were aware of it, but we didn't probably appreciate it enough. Another surprise, though, is that we were able to get this far and get inflation down this quickly without seeing a big increase in unemployment. And that's just a great result. That's just a surprise. It's not consistent with the historical record, but it's a really positive thing.
Thank you. And I would just know the only tools you had available were demand side tools.
Yeah, that's right.
Thank you. Thank you, Mr. Chairman.
Thank you.
Senator Warner of Virginia is recognized.
Well, thank you, Mr. Chairman. Chairman Powell, it's great to see you. I would point out to my good friend from South Dakota, I do think, if we'd gone back a year to 18 months ago, nobody would have predicted a soft landing. And I know you're not ready to declare victory by any means, but the fact that inflation has come down, I actually think some of the things like the CHIPS bill, the infrastructure bill, and some of President Biden's policies have actually kept the economy growth rate at the levels that have allowed you to bring down inflation without seeing a dramatic rise in unemployment. And again, that'll be something we'll probably have the opportunity to litigate over the next 8 or 9 months. I want to take my time on issues around less about monetary policy and more about regulation. I think we can never presume that we're out of the woods on financial stability, as we saw with the New York Community Bank yesterday, the stock plunge and the capital infusion.
Fed Chairman Jay Powell's testimony before the U.S. Senate.
One area that I raised with you a year ago, we raised today, and that is non-bank lending. The fact that non-bank lending in terms of to non-financial firms now is actually exceeding regulated bank lending. And let me be clear, I've got, the non-bank financial sector has done productive things in our society over the years. But when folks like former New York Fed President Dudley and former Fed Governor Grosvenor recently said that they had worries about this reliance on the non-bank financial sector could lead to overall economic lack of stability. I guess, what do you think? I've got a 3-part question. What do you think are the risks as we see this push-out effect of more and more lending going outside the regulated perimeter to the non-bank